Governor Waller brought the booze to the party, so let's talk about Governor Waller. Yeah. He said something's giving, and it's the economy. Is it giving?
Yeah, so if you look at the data that we have in hand, everything looks pretty strong. We just had a strong jobs report. GDP growth in the third quarter has surprised everyone, maybe except for Atlanta Fed GDP nowcast. And in the fourth quarter, it looks like we're going to come in somewhere between 1% and 2%. So it's really hard to look at that economy and say things are kind of falling apart here. On the other hand, if you look at some of these more forward-looking indicators, things like the unemployment rate that's coming up, I know it came down last week, but it's still up off of its low. Continuing jobless claims are rising. Credit card delinquencies are rising. And if you talk to businesses, you talk to people, there is a sense that things are slowing down. So I think we're hearing a lot about maybe the Fed will be cutting interest rates because of inflation. I think really the Fed is ultimately going to be cutting interest rates because of activity slowing.
Economic weakness.
Economic weakness. And that's contrary to what Waller said. So if you read Waller's comments when he was talking about, could we be cutting in 3, 4, or 5 months, he explicitly said, I'm not talking about growth. I'm not talking about recession. We're not trying to save the economy. But I think what they're seeing is this very narrow path to a soft landing. And they think they're on this narrow path to a soft landing. And if they don't start bringing out these cuts, they're not going to be on that path anymore. So they have to kind of really contort themselves to move from the Fed that was fighting inflation and was focused on inflation, and super core was going to be the guiding light, and if that stayed high, then you couldn't be cutting rates. Well, super core is still high, but now they're getting a little bit worried, and they want to be starting to cut rates. So we're getting this kind of awkward transition, and I think that's what we're going through today.
I want to be really clear about the journey that you and the team have been on since the start of 2022. I remember when you at Citi and Ethan Harris at Bank of America came out with some big calls about how big this hiking cycle would be. And I have to say, when I quoted your work, a lot of people pushed back and almost laughed. They did not think the Fed would go this far. You've changed your views on where we're going with this Fed. I remember only a couple of months ago, we were looking maybe for another move, perhaps even 2. You were talking about inflation going into year end, perhaps starting to surprise to the upside again. Going into next year, where are you now on inflation?
Yeah, so we actually still see inflation that's staying kind of stubbornly high. It has surprised lower than we expected over the past few months, and I think that's where Waller and some of the rest of the committee are seeing this kind of opportunity to be more flexible, where inflation has come down faster than expected. Most of that surprise has really been on the good side. It's really goods inflation that's come down. That makes sense when you think about the global context. Why are we getting slower inflation globally? Because goods inflation is slower, and that's a global issue. What's holding up is service sector inflation. We saw that yesterday in the inflation report. We're still running strong, so-called supercore services, excluding shelter. And then shelter prices is maybe getting a lot less attention than I think it should be, because there was a very strong expectation that that would have slowed by more than it has. And it now looks like it's maybe bottoming. We look at some of the forward-looking rent data, and it does look like those shelter prices can be picking up. So there are reasons to think that we're going to have some pretty sticky inflation here. Maybe they could even accelerate if the economy keeps expanding. Again, in our base case, we think the economy will slow down. That should ultimately be the deflationary force.
Well, is the 100 basis points of cuts that you have kind of gamed out for next year pricing in stagflation then?
I wouldn't call it stagflation in the sense that, in our base case, core inflation is around 3%. So you don't really want to compare that to the 1970s when we had double-digit inflation. But there is an element of that. And I think if we didn't have this kind of inflation, what John is talking about, the Fed saying, well, we're seeing some signs, we're getting a little bit concerned about activity, they might be cutting already. Right? They might cut earlier, they might cut faster. So part of the reason that we have the first rate cut not until July, and we have this 25 basis points at each meeting, we could talk about it, Tom, but we have 25 basis points at each 50 basis points at a meeting or 75 basis points at a meeting is the idea that you're still also contending with inflation that's running too high.
You had one of the great calls of 21-22 of higher rates, and it was based off stimulus from COVID. Are we still in COVID? Is this a COVID Fed meeting still?
It's a great question. I think on the good side, we are largely beyond the COVID distortions, which is why we've gone back to a goods disinflation. And we actually might be disinflating from those COVID level prices. So we're still kind of dealing with that, and we might normalize at a higher level of goods inflation. But what's looking, less COVID related is the labor market, the service sector. where we were seeing this kind of COVID distortion where every restaurant was trying to reopen, and that meant we had really rapidly rising wages, really rapidly rising prices at restaurants. That's kind of normalized now, but that's exactly the problem as we see it. So I think the Fed looks at that and says, okay, good, things are normalizing. We look at it and say, things are normalizing. It's not like it looked like, 1 year, 2 years ago, but we still have a very tight labor market. We still have wage growth that's inconsistent with 2% inflation. So it's not clear to us that this is really converging to 2%, maybe converging to something more like 3 or 4.
Do you think Chairman Powell cares that stocks are up 10% since the Fed last met? Does that matter?
I think ideally he would not have wanted financial conditions to loosen this aggressively. Remember, it was only at the November FOMC meeting when tighter financial conditions were going to do some of the work for the Fed. That was why they could be less hawkish. Well, all of a sudden, those financial conditions have almost fully reversed. We have 10-year Treasury yields that are lower. We have equity prices that are higher. But because of what's happening in the economy, it's hard for Powell to strongly push back against this. So we get this real asymmetry where when financial conditions tighten, we had the Fed, we actually had the Treasury, right? We had policymakers in general that worked very hard to stop that acute tightening of financial conditions. Now that financial conditions have loosened, I think in Powell's mind, he'd say, well, what's the risk? The risk is that we run some higher inflation. If we start to see that in the data, we'll deal with it at that time. This is not something that he'll respond to today.
Andrew, this was great. Andrew Honhorst of Citi, it's good to see you, mate. It always is. Coming up next, we'll talk banks. The equity market up something like 10% since the Fed last met. Regional banks are up more than 20% since then. From New York City, this is Bloomberg.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Will the ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimates, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything.
Bank lending has really stalled here at this point. It's a critical part of the economy. Banks play a critical role. And if the banks are sidelined, I think it's going to starve the economy for credit, and it's going to expose the weaker hands over the course of the first 6 months of next year.
That was George Concalves, the head of US macro strategy over at MUFG. The Federal Reserve a little bit later on this afternoon. Three-part story. Get a statement, projections, and a news conference with Chairman Powell. And then for many of you, year over. Although Brammer will remind you, retail sales tomorrow. The Bank of England, the ECB.
Yes, correct.
If that takes your fancy.
It does.
Equity futures on the S&P 500 look like this. Futures are positive 0.1% on the S&P. A minor, no drama move this morning. But over the last month or so, since the Fed last met at the start of November, we have seen a move of about 10% on the S&P 500. And if you want to look at the regionals, the KRE, the regional banks in America, TK, up by more than 20% since early November.
It's a pop. I've looked at a number of the charts, including the Keefe, Bruyette, and Woods chart, and the answer, the two different, two basic indexes they have. And I get it that it's bounced up, John, but it's stunning how far we went down and how far we have to get back in.
Yeah, we're still not there, let's be clear.
Big banks to get back is a long ways away.
Nowhere near the highs.
Yeah, no.
All of this, Tom, off the back of the bond market move. It's been phenomenal.
Well, yeah, the bond market move, I think, is correlated right in, and the correlation is also there's this feeling out there somebody will save everybody. I mean, is that still out there? I mean, it's not. I remember Robert McTeer, they shut down 10 banks in a weekend. I literally remember, John, in the 70s, Bob Seger on the radio, you're going down, you can see through the floor of your car because you're broke, and you look at a bank and go, are they going to be in business Monday? That was the tension that was out there. There's none of that tension.
We had a little bit of that stress, Tom, in the spring.
Yeah.
We don't have that stress in quite the same way.
Our stress is to get the right person to talk to. Christopher McGrady is with KBW. They are the institutional investor mid-cap bank. Do you look at JP Morgan at all, or you just ignore Fortress Diamond?
You have to look at it. You have to look at it. It's a bellwether for the industry, absolutely.
But it's like mid-cap. So I want to go to Tacoma, Washington, one of the banks you follow. I don't even know where Tacoma is on the map. Tacoma, 98403, Columbia Banking System. Where are they going to be in a year? Where are the mid-caps like Columbia Banking going to be in 5 years?
Right. I think consolidation is part of the question, Tom. Columbia is a bank that's doubled in size over the past 2 years, and so we think scale is really important in this industry. We've done a lot of work, and there's a really strong correlation between the size of your bank and the degree of profitability, and importantly, the market rewards scale. They also punish scale, and I think regulation is one of the things that we have to deal with out of the COVID.
Have you been surprised by how little consolidation we've seen between the stress of spring and now?
No, I think it's an evolution, right? The spring was forced consolidation. It was failures. We saw 3 or 4 notable failures. But as the industry picks up the pieces from March, and that is happening, we will see consolidation. The industry still has 4,000 banks. That's the only developed country in the world that has this level of fragmentation. And I think one of the consequences of failures and stress is that we need to pick up the pieces and move forward.
What's the right number of banks?
Fewer, but I think what's important about the number of banks is we need more competition for the top 3 or 4, right? The biggest banks are the most regulated in the world, but there's really a general hesitation by the regulators to let the bigger banks get bigger. So the regionals, the 100 billions, the 200 billions, they need to be bigger to compete more effectively with the JP Morgans of the world, the Wells Fargos of the world. We think once the rules are written on regulation, and there's a lot of pushback on regulation, that is an opportunity over the next several years.
Where is the growth going to come from? Is it going to come from deposits? Is it going to come from consumer lending? Is it going to come from some of the areas where they suddenly have some real competition from private credit and private equity firms?
I think near term there isn't going to be a lot of growth. Just to be very candid, I think the banks are deleveraging. If you go back to the financial crisis, they had credit first and deleveraging second. This cycle, we are deleveraging, we are shrinking balance sheets, we are raising capital and liquidity, and I think going forward, that's going to be a challenge for the next 1 to 2 years.
David Conrad at your shop covers the larger regionals like PNC Financial and all they do for the Pittsburgh Pirates. Great. When do they finally merge to compete with the major banks? I mean, it's ridiculous. We used to have 5, 6, 7 major banks. Now we've got 4 with an asterisk. That's called Citigroup. Okay, but we got to get more major banks. When do the PNCs get to play?
I think we need to know what the rules are going to be. Basel III is a big development that's being debated right now. I think near term, with the credit uncertainty in the economy, I think pencils are down for M&A. But I think over time there will be more consolidation.
Think about what you just said. We got to get more major banks. Does anyone in Washington agree with Tom?
No.
Not right now. No.
So why would that be the direction of travel anytime soon?
Because every other nation's done this. You mentioned it.
I'm with you.
I
totally get that.
This goes back to Andrew. This is Wendy Schiller territory.
Okay, but we have to figure out why we're sitting here in this sole, lonely, developed nation with 4,000 banks. We're here because someone wants us to be here, right?
But regulation changes, right? So for 2008, global financial crisis, the 50 billion systemic level was put a line in the sand. That was walked back in 2016 after the Trump administration. So without getting political, there is an element of political consideration that you have to think about.
I mean, I just remember, John, being in London as a paperback writer was just released by the Beatles. I'm walking around, there's no banks. I mean, I remember looking around compared to America. There's a Bank in America on every corner. And that's not true.
Well, you're bringing up a different conversation. The footprint on the high street, on Main Street in the UK has changed massively. We've seen a lot of closures. I don't see that in quite the same way here in the States. Why is that?
The branch closures. You're seeing smaller and fewer, but certainly there's a lot of regulation you have to also pay attention to. Fair lending, making sure a bank has exposure in certain pockets of the economy in different markets.
What's the advantage to having strong regional banks? I mean, with all due respect, there's this question of whether banks have been saved again and again, particularly on the smaller end, who didn't hedge appropriately when it came to some of their interest rate exposure, who invested in a lot of commercial real estate that was faulty. And a lot of those activities in terms of consumer loans are moving to other investment firms. What's the argument for beefing up this industry in a more material way?
The smaller banks are the lifeblood of the economy. JP Morgan, great company, Citigroup, Wells Fargo, big, powerful institutions. But at the local level, you do need the local small bank to give that customer service. Now, you're right. A lot of mistakes were made with interest rate risk and interest rate management, and those shareholders and those companies certainly paid the ultimate price. But I think for a healthy and thriving economy, you do need more scale and size across the gamut.
If you took the three of us. We haven't been in a branch since I think, the Red Sox were in first place.
Speak for yourself.
I'm going to say the same thing.
We do everything digitally, Zelle this, Zelle that, all the rest of it. In our banking, how does Columbia Savings Bank, Tacoma, Washington, compete with the digital investment of the major banks? I just don't understand that.
Right, the smaller banks are certainly 1A. The bigger banks are going to move first. The small banks are going to adapt second. But certainly they have built out capabilities, these smaller banks, to compete effectively. Maybe not to the sophistication of an international bank.
Give us an example of that. What's a capability they have in Tacoma, Washington, where they don't want Brian Moynihan to come in from Bank of America?
So I would say turnaround and online speed for deposit capture. Right? We can go and deposit money without going into a branch. I haven't been to a branch either in years. And certainly,
Thomas Schode goes in every day. Be careful what you say. President of KBW.
We do. But the capabilities for you and I as a consumer, certainly the smaller banks can accommodate that. Maybe they're not going to have the budget initially, but they will follow.
This is a really hard rally off the lows for the regionals. We're still down about 25% from the highs of the year. Any reason to believe we reclaim those highs next year?
Right, we're still market weight, the U.S. banks. We moved, this is the 1 year anniversary of moving to market weight. And what we've seen over the past 12 months is a 30-point divergence between the S&P and the banks. And so the first part of the year, the spring, was really about net interest margin, net interest income, deposit flows, and systemic risk. That leg of the relay race has largely played out, and that's stabilized. What we're feeling now is, what is credit going to look like as interest rates have risen? How much of a credit normalization process are we going to go through? And how much will this weigh on earnings estimates going forward? The key for us is the direction of earnings dictate the direction of the stocks.
Not just the direction of the 10-year yield.
Now, the last 3 months has definitely been a trade on the 10-year.
It's been amazing, Lisa. All of it, pretty much off the back of this move in the bond market.
And completely counterintuitive, because usually higher rates were good for banks, and now lower rates going down pretty rapidly are better for banks. This is default risk. This is concern about withdrawals of consumer deposits. This is concern about breaking the system. If that's taken off the table, people can get perhaps a bit more opportunistic.
In 20 seconds, any reason for that to change anytime soon, the correlation between bonds and regionals?
I think the question of why rates are coming down, are rates coming down because inflation is moderating, or is it because growth is slowing? Your prior guest talked about that. If we get a softish landing, which KBW is in the camp of softish, I think the banks can work, but I think if it's because we see something break in the system, and I think the futures market 100 basis points a little ahead of itself. Yeah. But if credit's the big wild card.
They were the things breaking earlier this year. Chris, it's good to see you.
Good to see you.
Big change in the last month in this market. More still to come on the equity market. Coming up next in the next hour, Gargi Chowdhury of BlackRock. Stocks this morning positive 0.1% on the S&P 500 from New York. This is Bloomberg.
The island emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
we had some pretty tough talk.
Bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report tonight at 9:30 Eastern. Bloomberg, context changes everything.
The shape of the On athletic shoe is unique.
It can't be mistaken for any other brand. The structure of ON's C-suite is just as distinctive.
Hello, I'm
starting at the top with a pair of CEOs.
This morning, as you can see, we purchased Bitcoin. It went down, so you have time to buy at level, but we follow our strategy, and this shows us that it's time to buy. If it will go lower, we will buy again. But for time being, we own one contract for Bitcoin. I want to remind that 1% equals 1,000 pounds in our case. Okay? I'll speak to you later, guys. Stay safe.
Different mindsets and very diverse people. Mark has different strengths. I have different strengths. And if you take us together, you just get more.
Companies with co-CEOs are rare, but ON's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Right now, it's a Fed pivot party, and we're all invited.
The key thing is that we are seeing inflation slowing, and it's consistent with what the Fed expects.
We've hit peak rates. We've hit peak Fed. Inflation is slowing.
Well, I think inflation and vol are moderating. I don't think we're going all the way back to where we were in 2019.
If we see stability in inflation, and then as we move the calendar page into 2024, we see a little bit of an uptick, I think that could force the Fed's hand to take one final rate increase.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
I just get excited about the holidays. The last Fed decision of 2023. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance, live on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P positive by 0.1% this afternoon. Chairman Powell, TK staring down the barrel of a market pricing big rate cuts in 24 and following a massive rally since the last Fed meeting.
And you said it great in the last hour. You were looking at the testimony of Vice Chair Biden and Chair Yellen as well. There's a little bit of political ballet in Washington on this meeting. This is not just about monetary policy.
So this was Chair Yellen. Can you imagine if Chair Powell said the same thing today? I personally don't see any good reason to think that the last mile is going to be especially difficult.
Yeah.
A soft landing in the economy continues to grow. The labor market remains strong. Inflation comes down. And I believe that's the path we're on.
All these people, and Andrew Hollenhorst is great at this with UCLA and with Citigroup. All these people have a heritage. You mentioned Waller. Waller is bulletproof St. Louis research. study. He's an academic, a research wonk as there's ever been, and so is Yellen. She is our voice on labor economics. Chairman Powell, not so much.
The party already started. Governor Waller turns up with tequila. Bramo, off to the races. That was kind of like the last few weeks, right?
It has been. I mean, that's what we heard yesterday from Emily Rowland. It's a Fed pivot party, and everyone's invited. And I got a number of messages yesterday saying, I've been invited to a different party. You know, there has been a lot of pushback to that, but there is this feeling about soft landing. And right now you can feel a frustration in the White House. Come on, the rest of the population, get on board with a soft landing. So here's the question. Fed Chair Jay Powell is going to not comment at all, right?
Sure.
But this is going to be the key question. Are we going to get rate cuts, as you've said, for the right reason? Are people going to start to question why they are pricing in 100 basis points of rate cuts? Andrew Hollenhorst came here, had the same year-end projection for rate cuts as priced into the market, but the reason why, completely different with a completely different subset of outcomes.
I wish they would establish the reality, which is by definition they're what the fancy people call ex post. They go after the fact. So for him to say today, here's where we are, we by code have to be after the fact. We don't know if after the fact is this meeting or that meeting, the other, but everybody calm down because we're going to be late. That's the fact that we have to live with.
The statement, projections, news conference, all coming up a little bit later this afternoon. Here are the scores right now this morning. S&P 500 futures positive by 0.1%. In the bond market, yields lower by a couple of basis points. On a 10-year, Lisa, 417.76.
All right, 8:30 a.m. we get the latest in inflation data. We haven't mentioned CPI once yet this morning, which tells you exactly how surprising it was. It wasn't. 8:30 a.m. we get U.S. November producer price index. An interesting way to look at margins for companies. If you do see a tick up in terms of inflation on products and you don't see the same kind of tick up in consumer prices, that's margin compression. That's what I'm watching for. 1:30 p.m. surveillances. The Fed decides begins. We will be back on air. Drumbeat to the Fed decision. JP Morgan's Priya Misra will be joining Deutsche Bank's Matt Lazzetti, Michael Gapin of Bank of America, Bill Dudley, former New York Fed president, all giving some key indicators of what to watch, then after how to understand. And of course, 2 p.m. is the rate decision. We're going to be looking at the statement of economic projections. Do they have 50 basis points of rate cuts? Nobody will really care. 2:30 p.m. Fed Chair Jay Powell, he'll come out and he'll try to do this dance. We don't know. I don't know what Chris Waller is saying. We're all independent. We're going to take things as it comes.
Sure.
How does the market respond might be the more interesting end.
All the ingredients, Lisa, to get absolutely whipsawed by all of this will be fixated on the 2024 dot. And if the 2024 dot starts to move towards the market, which most people assume it will, the market can go one way.
Is that what we're seeing
and then
this
Chairman Powell in the news conference, TK, push back as much as he likes.
What are we seeing it this morning? We got a further lift in the market after a VIX print of 11 yesterday. I think the market's getting out front of what you just said.
I think we've done that over the last month.
Yeah.
About a move of something like 10% on the S&P 500 since the Fed last met. With us around the table, Gagi Chowdhury, head of iShares investment strategy over at BlackRock. Gagi, good morning.
Good morning.
Let's start with your rate cut call. Back half of next year. What are the reasons that underpin it?
So the main reason is that we don't think that the Fed has yet talked about how much deceleration of inflation has taken place. So the reasons, and to your point, and I know you speak about this a lot, are they good reasons or are they bad reasons? The bad reasons obviously is a severe exogenous shock to growth. We think it'll be for the good reasons. So inflation coming down, we're already seeing that. I know, Lisa, you said no one cared about the CPI data, but we did care. We looked at the fact that 6-month annualized CPI on the core is down to 2.9%. That's really good news for the Fed. And I think they'll begin to recalibrate. I think that's about 50 to 75 basis points lower for 2024. And they start doing that by perhaps the June meeting.
Gagi, you said 2023, yield of dreams.
I did.
What's 2024?
It continues to be a yield of dreams. I mean, this year, obviously, fixed income did not have the year, at least in the beginning, it didn't quite have the year that we had hoped. But by the end of the year, we started seeing those yields move lower. I think 2024 continues to be the year of income. It continues to be the year where bonds generate, especially high-quality bonds, generate that return for you. And I think the 2024 is also the the year that investors step out of cash. I think that's what I'm most excited about. All of that hoarding in cash that we have seen, that $1 trillion that we have seen, I think this is the year that investors feel comfortable stepping out into both the equity and the fixed income markets.
My double major in college was ice hockey and Led Zeppelin. You have the best double major of anybody we talk to, accounting and psychology. I've never, that's so warped, I don't know what to do about it. But the psychology that you nailed this year, and you bring it over to get out of cash, and also what everybody's talking about, but you are direct about, you got to find the lovable legends that haven't moved. Define what a lovable legend is. What's our psychology to finally buy those?
Yeah, the lovable laggards that we're talking about are some of those industries, some of those sectors, even geographies that did not participate in the rally. So healthcare is one that we've been thinking about with good earnings growth projected for 2024. And actually, when we look at some of the details for pharmaceuticals, we find that some of the quality characteristics, so cash flow as well as balance sheet strength, are available. So, however, it did not participate in the same way that we saw, of course, the Magnificent Seven or the tech and communication services sector. So we think certain parts of the healthcare sector can be a really good laggard for 2024. And listen, it might not start immediately. I think we might need to see a little bit of assurance from the Fed that no more hiking is going to happen. That's certainly our base call. But I think that could be an area of the market that catches up.
I love your call that cash is no longer going to be the most important asset class and that money is going to actually start flowing out. What's the trigger going to be, given that two-year yields are still 4.7%?
Yeah, I think it's just this recognition, and we did this analysis, that there has been a little bit of lack of urgency. There has been a view that rates are going to stay much higher for much longer, and you're better off sitting in cash and thereby missing out on the rally in the equity markets, and this year was the prime example of why you needed to step out of cash, because you missed this incredible rally in the very high quality parts of the market. So I think the recognition that the Fed is indeed done, that there is no risk of a 6% Fed funds rate, there is no risk of them doing something shocking which continues to push interest rates higher or even equity markets lower. I think that recognition will help investors to step out of cash into, we continue to believe, fixed income markets, much like we saw this year, especially in ETF inflows in fixed income, as well as high quality parts and some of those lovable laggards.
Which raises this question, are we going to see big tech lead one more time again? I mean, aside from the credit side, is this just going to be money chasing returns from 2023?
I think if we look at where some of the earnings growth is coming from, they tend to be those areas of the market that have the lowest leverage, that have the strongest balance sheet, that have the best, John was talking about the margin, you were talking about margins earlier, that have the best margins. Some of those are in the large cap parts of the market, not just tech though. All large caps. So when we think about why investors should continue to focus on quality, it's not just a tech story, but a large cap story. So yes, I think there can be periods of large cap outperformance, certainly in the first 3 months of the year. And you have to pair that with some of the laggards in a core and satellite allocation. That's how we think investors should play this.
What's the biggest mistake people make in ETFs? I mean, it's become a cottage industry. I remember going to some of the first ETF meetings. John, they threw me out of them because the spreads were so high. It was a scam. It's not a scam anymore. It's here. It's real. It's wonderful.
Yeah.
But what's the number one mistake people make in ETF investment?
I think the number one mistake that people talk about is this idea that ETFs are somehow ruining your liquidity. And what we find out over and over again is that access to ETFs is in fact adding liquidity to your portfolio. The number one mistake that people often talk about is this active versus passive debate, and that is long over. Right now we're talking about ways in which active investors can use ETFs in their portfolio, and we ourselves launched some incredible active ETFs.
Like the active management of the triple leveraged all cash ETF. It's really lagged here. It's like bottom quartile.
Can I ask you a really short-term question? Like 7 hours and 30 minutes short-term.
Yes, go.
Is Chairman Powell going to push back later?
I think he is. I think given the trajectory of OER and shelter prices yesterday, he has to push back just a little bit on the amount of rate cuts that have been priced in for 2024 and how quickly. I think the March cut is the issue, not so much the 110 basis points of cuts.
We've seen the market has had selective hearing over the last few weeks. Do we get a response to that?
I think they have to be a little bit more forthright about the language, at least a little bit stronger than what he used in the Spelman College speech. I think he will do that. Maybe time to bring back the not thinking about silliness.
That would be pretty strong, Tom.
That would be.
If we were at that point where we're not thinking about rate cuts, that would be some pushback.
We were talking before here. I mean, Gargi and I are worn out by the Fed talk. I want to talk about earnings talk, resilient American economy, the technological excellence, not just in technology shares, but in healthcare shares. Take the technology overlay, the supposed AI revolution, bring it over to United Health. Those kind of questions.
Big moves in this equity market. Unfortunately, Tom, nothing to do with that. It's been off the back of the rate cut debate at the Federal Reserve. A move of something like 10% on the S&P 500 since the last time the Fed met. Equity futures this morning, positive, 0.1%. Gargi, I know you had a final thought. You can share it with us now. What was it on the Federal Reserve? TK kind of jumped in as you were about to talk.
First time that's happened.
I was just going to say that I do think they push back given the trajectory of Fed strength, but in CPI for shelter. But I also think that they're very cognizant about not preparing the markets for any more hikes. So I think they'll have this balance where they say that they're going to just be on pause for a little while. I think it's okay for the market to just stay on pause so we don't, what I'm excited about in 2024 is to not hang on every single word that the Fed is saying, at least for the first half, just be on pause.
How likely is that, Gargi? Come on.
I think for the first few months, I hope quite likely.
Okay.
Let's just wait and watch the higher rates do its magic.
I think we all share that hope that we can move on from a lot of this. Gargi, wonderful as always. It's brilliant to see you. Have a wonderful Christmas. Gargi Chaudhry there of BlackRock. Thank you. Equities right now just about positive by 0.1% on the S&P 500. Later, if we get that pushback in the news conference, will that 2024 dot, the median dot, compromise their ability to push back if it shows more cuts from the last time they gave us projections?
It's a great question. How do they then understand the conditions required for cutting rates if they don't ratchet back their expectation for growth, ratchet up their expectation for unemployment, and paint an otherwise bearish picture for the economy?
The jobs market's got a crack, and it hasn't cracked yet.
Not on the surface. Beneath the surface, you're starting to see these
I'm getting lots of love
little cracks. Coming up on the program, Bloomberg's Anne-Marie down in Washington, D.C. on Chair Yellen and Vice Chair Biden on the Federal Reserve meeting before the Federal Reserve meeting. More on that in just a moment. From New York, this is Bloomberg.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. Today, the Fed decides.
We're talking rates. We're talking inflation.
Without a recession. That's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg surveillance. The Fed decides. Today on Bloomberg.
We'll continue to supply Ukraine with critical weapons and equipment as long as we can, including $200 million I just approved today. But without supplemental funding, we're rapidly coming to an end of our ability to help Ukraine respond to the urgent operational demands that it has.
That was President Biden speaking alongside Ukraine President Volodymyr Zelensky at the White House yesterday as the political fight over aid continues with Speaker Johnson. From New York City this morning, good morning. Here's the price action for you going into the Federal Reserve decision a little bit later on this afternoon. Treading water, as you might expect. Futures just about positive by 0.1% on the S&P. Yields just a touch lower. Still sub 420 on a 10-year. In between 4.1 and 4.2 over the last week or so. 417.95 on a US 10-year this morning, TK.
It's going to be amazing to see of those single data points, the 4 key data points on radio. We throw up the 4 key data points on TV. John, I've got to say I'm stunned with the 4.18 10-year, which really tells me people think this is massively baked in the cake, inflation, disinflation friendly, I should say.
Oh, without a doubt. Market off to the races.
But that's a one statistic that
which
really
is why, TK, I would say if you get pushback from Chairman Powell, how credible is that pushback? Given what we've seen in the economic data, even President Biden coming out after the payrolls report on Friday, and we've been joking that it's Vice Chair Biden of the Federal Reserve with his pre-meeting meeting, a sweet spot that's needed for stable growth and lower inflation, not encouraging the Fed to raise interest rates. Tom, it takes a certain degree of confidence, I think, to come out and say those things, even if it is one part economics and 10 parts politics.
Let's stagger around here. I'm putting it up on the Bloomberg right now, John. You stagger around to, I got to hit the go key to do this. I've never used a Bloomberg before. January 31, March 20, May 1st. Okay, Lisa, do we assume it's like a July action by the Fed? I don't think they have that luxury. You got 31, March 20, May 1, June 12. All those choices, all those moments, they're going to get there sooner rather than later.
The way that Fed Chair could push back and be credible is if he highlights key reasons for being bearish on the economy, for seeing real signs of slowdown that perhaps are leading indicators that people are not focused enough on. That would get the market's attention and perhaps not in the best way possible.
Governor Wallace said something's given. He said it was the economy. But I think we always have to frame it like this. Think of how ridiculous this conversation now sounds 12 months ago. 12 months ago, going into a new year, and we're talking about where the Fed might be. And then 3 months later, in spring, we have banks failing. And then people are talking about the cycle being over and the Fed needs to back away and start cutting interest rates. And then 6 months after that, we're in a third quarter with 5% GDP growth. Tom, this year did not materialize in any way, shape or form in the way that so many people thought it did. And plus, once you started getting the outcomes people didn't predict, you didn't get the Fed outcome people thought we'd see either. So let's just frame 2024 with a little bit of humility after the ridiculous 2023 we've just had.
And our question to Andrew Hollenhorst, and I think it's pandemic induced. Now, Hollenhorst parses it that on a goods basis, we're beyond the pandemic. On a service sector basis, we're not. But I think all that cacophony of 2023 was living with the debris of the pandemic. And, you know, that's not in the mandate of a central bank.
So second half, we've got rate cuts over at Citi. Other people agree. The longer that goes on through 2024, the more you start to think about that maturity wall in Lisa's world in high yield. There's a lot of companies that need to come to market and raise some debt. They're hoping perhaps we get those interest rate cuts sometime soon. We'll see if we do.
Yeah, we've heard that, Lisa, right? Within your reading, I mean, there's going to be an issuance frenzy, right?
Which is the problem with some of these bullish credit calls and the reason why everybody is hedging those and saying high quality.
This afternoon, we will dive into this. Are we at 1:30? I don't know. I've got a long lunch. Are we at 1:30 or 2?
1:30.
Show starts 1:30.
1:30.
You can turn up late if you want.
Oh, I may show up late. We'll have to see. On that, always like the lunch is Anne-Marie Horton, our Bloomberg Washington correspondent, and joins us this morning. Anne-Marie, there's 8 things to talk about, but I do have to go to this moment at hand. I'm going to give you an inflammatory statement, and I want you to amend it because it's an emotion in the zeitgeist right now, and that is America's going to allow Vladimir Putin to win. take that inside the beltway, that emotion, and where are we going to be in weeks and months?
Well, this is what President Biden was trying to get across yesterday. He is claiming that Republicans are holding hostage this Ukraine aid that can only help Putin. This is what Volodymyr Zelensky also said this week when he was in Washington, that this only helps dictators like Putin and Putin's sick clique. So this is, the push and pull we have amongst Republicans and Democrats going into the holidays. They're set to leave town this Friday, and it looks like they are not going to have a deal. Lindsey Graham couldn't be more direct about it when he spoke to reporters after he was briefed by President Zelensky. And this is an individual who is a defense hawk. And he said, I told President Zelensky, my #1 obligation is to secure my country as well as help yours. Republicans want a strict border policy or there's not going to be Ukraine aid.
We've been talking a lot about international aid and international policy for President Biden. How much is that muddying his domestic message? He's trying to nuance it. Yesterday, we're talking about how he's vice chair to Janet Yellen's chair of the Federal Reserve. He said, today's inflation data shows progress lowering costs, with inflation down 2/3 from its peak, but I know many still find too many things unaffordable. How much is this a frustration within the White House, the lack of breaking through on the message of where the economy is right now?
Oh, it's a massive frustration because they're looking at an incredible labor market where under 4% on the unemployment rate for 22 months now. And what you have is poll after poll showing that voters, especially swing state voters, and this was in our last poll with Morning Consult, that they prefer the former president, Donald Trump, over President Biden's policies. And if you look at the pollster of Morning Consult, Caroline By, what she said to us is that it's almost 2-to-1 in swing states that they do not like Bidenomics, and they don't think that they're doing well under Bidenomics. So this is why anytime the president does see good data, whether it's CPI or even whether it's the jobs report, he always pivots the fact that he understands that American families are still struggling. Mark Zandi has said this. He talked about the fact that what you have is everything when it comes to economic data right now is colored by the fact that when you take pre-pandemic to now, a household is spending, what, $600 to $700 more on basic goods. But in the latest inflation report, what we are seeing is things that have really dogged this administration, like gasoline, are coming down handsomely.
That's exactly where I want to go.
Gas prices just above $3 a gallon. The timeline potentially for Biden going into November could be on his side.
MH, down in Washington, Anne-Marie, thank you on the latest. More still to come on this through this morning, of course. Just distracted by an email from Axios, Tom. Tipping season. Need to talk about tipping season. 15% of US adults will increase how much they tip this holiday season compared with last year. This according to Bankrate, personal finance site. 44% plan to tip the same amount. 13% say they're decreasing holiday tips this year. Brutal. 23% didn't tip last holiday season, Tom, and don't plan to this year either.
I was in a cab. I was standing outside a cab, and a guy was getting out of the car. Don't know what the fare was. It was none of my business, but I noticed that he didn't tip the cab driver. And I just go,
I just don't.
What do you...
Don't like that at all.
What do you... I mean, there's places where it's so painfully obvious tips is how people survive. I've been in that position a million years ago, 6 lifetimes ago. But to me, Lisa, this is a cultural thing in New York City. And yeah, it's to excess in some things. There's no question.
I think that people act with more impunity right now because there's a suggested tip on everything, even when you go buy groceries. And I think that
They flip the iPad around.
Exactly. They flip the iPad around, and then it's like suggested tip, which I think has created some anger.
Lisa,
that said, there are people who live off tips, and if you're not tipping your super in a serious way, who come in and fix the leaks and blinds and other things, you know,
we get afterthought to unload the dishwasher, and she's looking for a suggested tip.
She's like,
comes around the iPad, 25%. Doorman tips is where people get confused. People don't understand how much you should tip the doorman. People always get confused. What's the right amount? What's the right amount? Personally, I say 30% of your monthly rent distributed across the staff.
Oh, listen to you.
Wow. That was my calculation. 30% of the monthly rate distributed across the staff. And then for people who've been there longer,
pretty accurate.
they usually get a decent amount compared to the people have been here maybe 12 months or so.
Yeah.
That's my approach to this.
The answer is to live in a walk-up like me, where there's no doorman to tip.
Oh, right.
Sure. I used to live in that building. Equity futures on the S&P from a beautiful New York City, just about positive.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Just had an email from Jonathan. Thank you for that email. Tipping now is not for 2023, it's for 2024. It's to get them to come back for the next league, not the league you just had, which is true, right?
100%.
There's some of that in there.
Yes.
Got a huge response.
It's an insurance policy.
Thanks to the emails on this and all. People are fired up about this. Your hornet's nest, the Fed Day hornet's nest.
Everyone has this conversation. They always want to do more. They want to make sure they're generous. They're not just not sure what generous is in New York.
I get upset at the zeros. Just do a little. If you don't know what to do, you can't.
Well, do as much as you can.
I've been in jobs where on the bedroom dresser was all the cash lined up from tips, which is literally how you got through the month. And there's a whole group of people who've never enjoyed that feeling.
Oh, for a lot of people, to get through the year, Tom.
Yeah.
Never mind get through the month.
Yeah.
Yeah.
And to me, that's important. It's Fed Day.
Let's turn to the price action on this Fed Day. Equity futures on the S&P 500 positive by 0.1%, up 0.2 on the Nasdaq 100. In the bond market, what a turnaround we've seen. 2-year, 10-year, 2-year in and around 5% for so long, and back down to 471.37. We're down 2 basis points this morning. 10-year down about 418.14. So since the Fed last met, we've had a move of double-digit percentage points almost on the S&P, that and more on the Nasdaq 100. And on a 10-year, we're down something like 70 basis points, I think, Lisa, on a 10-year yield since the Fed last met in early November.
And for all the right reasons, right? I mean, this is, again, we have to keep harping on that this has basically been an acceptance of the fact that there is disinflation. That has been the news. When do we actually start to see the weakness? I think about Ernst & Young yesterday, and they're laying off a significant portion of people, thousands of individuals, because they're not seeing the same attrition. And that was interesting. People aren't quitting because there isn't the same kind of robust job market that there used to be. And that tells you where we are.
Quits rate is lower. Look at Hasbro. Keep going back to that story. Toy company 2 weeks before Christmas, cutting almost 20% of the staff. Unreal. Let's turn to the FX market. The euro against the dollar. Just a sneak peek of things in G10. The euro right now looks a little something like this. 107.88. We're negative by not even 0.1%. Classic Fed Day performance, Tom, ahead of the decision and the news conference later.
Well, just 20 seconds here on what we see tomorrow from the ECB. I mean, do we see fireworks, or are they going to jawbone their way through it?
They're going to go first in the minds of many, but not tomorrow. Do we get that pushback from Lagarde? I think Lagarde, and Lisa said this yesterday, and I think Lisa's right, has had the luxury of going the day after the Federal Reserve.
Yes.
100%.
Right, Lisa?
She's going to just basically pick up on whatever language he uses and says, yeah, me too.
Just gives her a little bit more luxury to craft that message after you hear what the Fed's got to say the day before.
Bloomberg, you've been in the meeting. John's been in the ECB meeting. You raise your hand and go, how about that DAX? You know.
You get a follow-up as well. You get to ask 2 questions in the ECB.
It's more civil.
2 questions. A bit more civil. Yeah,
Are we
DAX
under
record
surveillance?
high. CAC 40 record high.
Yeah.
Yeah, over in Europe.
US.
Let's get to the top story. Under surveillance this morning, the Fed expected to hold rates steady when it announces its decision at 2 p.m. this afternoon. Focus will be on Chairman Powell's news conference and the dot plot as investors try to figure out when the Fed will start cutting. The median projection in a Bloomberg survey showing 2 rate cuts next year, with 5 coming in 2025. Seems to be consensus, Lisa. I've seen anywhere between 2 and 3 cuts in that 24 dot.
Doesn't matter, and we've been talking about this. Honestly, at this point, I'm actually more interested in the unemployment rate and the growth figures that they put out than even the dot plot and exactly how many cuts they're going to be pricing in. The why of it is going to take on more importance at a time where, yes, financial conditions have become the most accommodative since the first rate hike back last year, early last year. So if that's the case and they don't push back, or if they say this is because the economy is going to be weakening, that's going to have a bigger impact on markets than just a dot plot.
We'll have a deeper conversation about this in just a moment. Just turning to other news, President Biden giving his sharpest rebuke to date of Israeli Prime Minister Benjamin Netanyahu and the fight against Hamas. Biden calling Israel's bombing in Gaza indiscriminate and saying the course of the war must change or Israel risks losing global support. At the same time, on a second front, Ukrainian President Zelensky failing to secure a deal for more aid to fight Russia, despite meetings with President Biden and House Speaker Mike Johnson. So 2 conflicts, Tom. Let's deal with the first one first. Israel. We knew there was division behind the scenes. We knew based on reporting that the administration was lobbying Netanyahu privately. This is coming out publicly now. Started, I would argue, just a week or so ago with Vice President Kamala Harris, and now you're hearing it directly, Tom, from the president.
Where are we in a week? I mean, forget about getting to Christmas, getting to the beginning of the year. I have no idea how this works, and I would suggest the apparatus of all the allies have no idea how this is going to work.
You tell me where the polls are in a month, and I'll tell you where we are in a month.
Fair, yeah.
Because the polls on this one, Lisa, going against the president in a major way within his own party.
Which is why it's not surprising that he's been a little bit harsher in terms of the rhetoric. If this wraps up in the next couple of weeks, could we then move on to some of the domestic issues? He's trying to push that in that direction.
The economy, not too bad. In Argentina, very different story. So-called shock therapy coming to Argentina as President Javier Milei begins his drastic plan to overhaul the economy. Argentina devaluing the peso by 54% with the announcement of massive spending cuts to close the fiscal deficit. Milei was elected last month after pledging to shutter the central bank and adopt the dollar as the national currency. TK may be scanning back some of the bigger suggestions in the campaign, but still some big moves Some big moves.
Bloomberg's got some great work on this, and what you do, folks, is you parse the Argentinian peso, which is moving from 366 out to a reported 800. I don't see that yet, I think. My eyes are failing me. No, I do not see that yet on the Bloomberg screen. And then you look at the blue dollar, which is the black market Argentinian peso. And I did the math this morning, and we've made up about the devaluation. It's the devaluation. We've made up, John, 64% of the path to the black market peso. We've gone to 800 and not out to 1,029.
He's making some real cuts, too, about 3% of the total GDP in terms of
political
budget.
cuts.
Political cuts and budgetary cuts. The question is, to your point, John, he's not going as far as some people expected. And some of the most radical of the candidates who get elected have become much more traditional in the people they hire and how they execute it when they're in office. That's sort of an interesting development that we're seeing in his case.
As an aside quickly to this is to the IMF spring meetings, they have a host of Argentina, Sri Lanka, in the news, John, as well in the last 48 hours.
There's some interesting economic experiments taking place, Tom.
Yep.
Anti-establishment, a lot of pushback in his campaign. We'll see how he gets on.
On radio, I still can't get used to the banner under handsome John Farrow, 4703 on the Standard & Poor's 500. Michael Schumacher, global head of macro strategy at Wells Fargo, joins us right now. Michael, I love your calculus illusion. We're on a down escalator or a down elevator. What does 2024 look like? Am I on the escalator or am I on the lower yield elevator?
I think you're on the escalator, so it's going to be a slow move down in yields, Tom, from our perspective. I thought it was really interesting to hear about the move since the last Fed meeting. It's been phenomenal in terms of equities, bonds, what have you. But we do think the market's a bit overdone. It's probably overdone as yields went up. We think it's overdone as yields have gone down. We like the direction. We think it makes sense, but the go slow path here is our preferred route right now.
How do you fold Jay Bryson's economics into your study? Is it a study of global weakness as the IMF structures out to 2028? Or can there be this surprise resiliency we saw at Q3 U.S.?
You can always get resiliency. There's a potential for a surprise. China's probably a decent example. Expectations are so low. Wouldn't take much for China to surprise to the upside. But I agree with Jay and his team. You think about the global backdrop economically, frankly, it's not that great, whether it's especially Europe. Canada looks like it's either in recession or very likely to go into one pretty soon. U.S. probably lagging behind a bit, so weakening but not as fast. But it's not a pretty picture, and yet that's really what you want from a policy standpoint. You've got to take the wind out of the sails of inflation.
You said that the move is overdone, and I'm curious which move in particular. Is it the fact that we're going to get so many rate cuts next year? Is it the fact that we're going to have a strong economy that persists despite where we are in this economic cycle? Or is it that this inflation can continue at the pace that we've seen?
No, what I was talking about, Lisa, was the yield move up and then down. We think the volatility in bonds has been extraordinary and too much. So thinking about other things that are probably a bit overcooked as well. Think about market expectations for easing by pick your favorite central bank, the Fed, the ECB, Bank of Canada, whatever it might be. They seem pretty aggressive to us right now for next year. That's not to say the central banks won't get there, but the market's ahead of the policymakers. So for instance, the Fed, price to ease 45 basis points, something like that, by June of next year. It might actually do it, but the market, we think, is running too far ahead of Jay Powell and team right now. So I think that also is a bit ahead of the game and overdone.
So do you think that essentially the equity bet that the economy will remain strong is the correct one, but the idea that disinflation will come down enough to edify rate cut bets is not going to really follow through? Is that your call?
It seems to me as really an equity layman that what's going on now in risk markets is risk markets are reacting to what they think central bankers will do. So as it becomes less likely central bankers will hike, or let's assume that's off the table, ex-Japan, more likely they're going to cut pretty soon. Risk markets like that. I think it's been about that simple. Chris Harvey can give you chapter and verse, but to me that seems to be the picture right now.
Mike Schumacher, part of this is just folding in what the dollar would do. John mentioned euro earlier. Wells Fargo's done some great work on euro, and all of this comes back to just the assumption of weaker dollar. I don't want to make theater out of it, but just an ebbing dollar, if you will. Is that your call?
Dollar probably weakens somewhat, Tom, but I think there's a consensus view out there, and we disagree with it, that the dollar falls out of bed. And the basic thesis behind that argument is, hey, the Fed's hiked a lot, the Fed's got the highest policy rate, therefore the Fed will cut the most, dollar weakens. Well, okay, but it's really all driven by the idea the Fed goes first. Why should the Fed go first? Why shouldn't the ECB lead the way, or maybe the Bank of Canada? So we think that view, the dollar really, I wouldn't say collapses, but takes a big hit. We think it's off base. A bit of weakness, yes, but massive weakness, no. We don't think that's on tap.
Let's play that game. Just priced in a lot of rate cuts over at the Bank of England. Growth not great. Mike, who do you think goes first?
So let's say the candidates, John, are Fed, Bank of Canada, ECB, BOE. I'll put the ECB in first place, Bank of Canada second. BOE is kind of a strange one to handicap. Fed's probably third, BOE fourth.
Is that a growth call or a disinflation call?
No, it's the inflation comfort level call, I guess I would call it. So how certain are you as a policymaker, whether it's Andrew Bailey, Jay Powell, whomever, that inflation's not just down, but it's actually out? That, to me, is what's going to dictate the path.
Hey, Mike, you're one of the best. Thank you, sir. And enjoy the holidays. Happy Christmas. Always great to catch up. Mike Schumacher there of Wells Fargo. Looking for the ECB to go first. And Lisa, how many times have we heard that in the last couple of weeks?
Consensus, I would say. It's going as far as consensus. And it raises a question of how many people are going to get on board with the parity call. The idea that, you know, the euro's got to weaken some if that's really the case.
And maybe from the 107, 108 it's at currently. If you are just joining the program, welcome. Your equity market just about positive by 0.1%. Yields are lower by 2 basis points, 417.95. We have got the perfect guest to talk about the Psalm rule, Claudia Psalm, the former Fed economist, joining us at 8:30 Eastern Time. Everyone's talking about this, TK, and we should be talking about it too.
It's sort of like Stephanie Kelton was a couple years ago on, you know, an original kind of economics. Psalm is sort of like the talking point this year because of all the gloom about recession. And to her immense credit, she pushed back against the certitude of it all the way along. She said, yeah,
and
but,
the use of
yeah,
it,
but, yeah, but, you know, to her great credit. I mean, she could have, she'd be on, you know, she'd be on like the Tonight Show and, you know.
Should be on the Tonight Show.
Should be on like.
Talking about these things.
You know, I mean, she'd be on, you know, general TV talking.
Labour market report on Friday changed things a little bit, Lisa. Unemployment comes in a little bit lower.
Basically, she came up with this idea that if you see that 0.5 percentage point increase in unemployment rates, that typically signals, in the vast majority of cases, recession. And then it was ratcheted back to 3.7% from 3.9%. So now you have to wonder, okay, are we in a different period of time? Is this just going to be spotty? And you're right. She herself has said, look, it's not really a rule. It's just historical correlations, and this could be a different moment. She's been very humble about this. But really, this is one of the angsty reasons why people are saying we could be heading into a tougher period.
That conversation in the next hour, Lisa, and looking forward to it. Coming up next, the man who's seen it all, Jacob Frenkel, the Chairman Emeritus of the Group of 30 on global central bank policy. That conversation just around the corner. Here's the setup this morning. Federal Reserve later, get a statement, projections, and a news conference with Chairman Powell. It's the last decision of 2023 for this Federal Reserve Committee. Equity futures positive by 0.1% on the S&P. From New York City, this is Bloomberg.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, you know, in 5 years from now, we will not have sacrificed, you know, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimate, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
As the economic picture
covering the intersections of Hollywood, Silicon Valley.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
To this point about whether the Fed cuts or not in March, it's just not realistic. And I'll point out in the last 18 months, the market has been overly optimistic on when the Fed has cutting. If our call is right, more likely to have a soft landing than a recession, clearly not cutting in March of 2024.
That was the brilliant Alicia Levine, the head of investment strategy and equity advisory solutions at BNY Mellon Wealth Management from New York City, counting you down to that Federal Reserve decision. Here are the scores right now in the equity market. On the S&P, positive by 0.1%. Yields coming in a couple of basis points. We're down 2 to 417.95. In the FX market, just about unchanged. The euro at 107.87. Interesting 24 hours for foreign policy. The President of the United States just yesterday labeling elements of Israel's bombing campaign as, quote, indiscriminate, going on to say that they risk losing global support. Well, here's the response from Israel this morning. The foreign minister saying that calling for a ceasefire is a gift to Hamas. Elisa, a minister in Israel saying to continue the war with or without global support. That is your direct or indirect pushback this morning.
The consensus within Israel about continuing this is pretty concrete, just because it is an existential threat to the nation. There is a real question about the divergence between the election cycle in the U.S. and the reality on the ground in Israel that is coming to the fore in a much more real way.
TK, that's the latest.
The headlines are moving here in time, and it does dovetail in with a 3-hour conversation with a guy who deserves a 4-hour conversation. He is Jacob Frenkel. He was born in what is called Mandatory Palestine, think League of Nations, in the British effort in the Eastern Mediterranean a few years back. Yes, he is Group of 30 Chairman Emeritus, and his relationship with J.P. Morgan Chase International, but far more also his leadership for Israel. His Israel is the former Bank of Israel Governor Jacob Frenkel joins us this morning. We should be talking your wonderful work with Raghu Rajan and Alex Weber, but I have to ask your perspective on Israel, their economy, their domestic place after these hostilities. How will Israel come out of these hostilities?
Well, thank you very much. Good morning. I'm very optimistic about the medium term of Israel, but we are now in the midst of a crisis, a war that started from an extraordinary, cruel, uncivilized attack on Israel, and the Israelis have to defend themselves. The cost is very high in terms of casualties, in terms of resources, in terms maybe of even of some political support. But it's going to be over. And once it's over, the record of Israel of rejuvenating after wars is very, very clear. We are picking it up very quickly. And once all the reservists are released, coming back to business, Israel will know how to re-emerge. The technology is still there, the comparative advantage is still there, the expertise are still there, and the markets are still there. So it is in this regard that the important thing is to cross that particular crisis.
Is a special relationship of the United States and Israel damaged or changed?
Well, to begin with, the special relationships are key to Israel. And Israel has, over the years, been the only democracy in the region sharing the values with the United States. So we are very, very grateful to the extraordinary support given by the United States, Of course, the United States has its own political cycle, but Israel now is fighting for its existence, for its the safety of its citizens, and it will need to complete the job with the most professional and careful way. But, you know, we are not dealing with a normal army that is fighting us. It's terrorism. And against terrorism, it's very, very difficult to have a very, very polite way to deal with them. And this is the issue.
I want to segue into your experience as the former head of Israel Central Bank, but also as the chair of the Group of 30, and kind of at the crossroads of understanding how to operate economic policy when you're dealing with fiscal policy that is inconsistent and maybe lacking in certain areas. You wrote in your recent piece, central banks cannot solve all that ails our economies and should not be expected to solve problems that other actors can better address. This was the discussion over years of financial repression. Do you think that there is the leadership to be able to take the helm away from central bankers?
Well, the important point is that leaderships are rising to challenge. And if central banks are stepping into each and every crisis, of course, it becomes overburdened. And once it becomes overburdened, it's becoming less clear, less transparent, maybe even confusing. So I think that what we have seen in the past few years is that we are operating in a very complex economic environment. You know, when I was governor of the central bank, life was very simple. We had to fight inflation, and you have an instrument which was called interest rates. The importance now of financial markets, of fragility, of speed of transmission, of expectations, makes it much more complex, and therefore we should be careful not to assume that the central bank knows more than what it does know, and it should specialize in the areas that it has comparative advantage, that it has the competence, has the tools, that is also protected by the law. And therefore the competence is about achieving and maintaining price stability, strengthening financial stability, and securing the fundamental of the financial markets. But by and large, this is the mandate. We have seen in the past, especially because we have had series of crises, real and nominal, domestic and international, that central bankers were very, very good citizens, and therefore they rose to the challenge and therefore went into regions and areas that are not exactly their competence and what they are expected to do. We call for go back to basics.
Which is the reason why I think it's interesting that we're talking about rate cuts in March, even though we're looking at a 4% core inflation rate in the U.S. And I'm wondering if there was this simple mandate, whether that would even be in the rhetoric at all, whether there's almost a political overlay in protecting something else by cutting rates at a time when inflation is still well above a target.
The important point is two things that you mentioned. Number one, we are talking about not current inflation, but expected inflation in the medium term. And this is the objective, in the medium term. And what you do now will have its impact over the next several quarters, quite a few. And number two, we should really not speak just about rate cuts or rate hike. You know, that's the way that we are all focusing every day. Will it be at 2 p.m. or 3 p.m.? Are we on the trajectory to stability in the economic system? And the central bank can contribute to this objective by securing price stability in the medium term. About the political support comes from the credibility that the central bank has earned and will have to earn in order to secure its actions. It needs to be clear, it needs to be transparent, it needs to be accountable, and it needs to basically chart the way. And once it charts the way, nobody will come back to it and say, yes, but we have a budget deficit. Well, deal with the budget deficit. If you are the government, the central bank cannot deal with it and should not.
Is it the end of activist central banking then? Do you think it is?
You know, activism means get out of the lane that you are driving, or make sure that you are driving carefully within the lane and being able to navigate within the lane. And activism does not mean necessarily a detour. It means, yes, have your eyes open and be your steering wheel is not going only to the right, occasionally also to the left, especially if the road is not straight. But the important thing is to make sure that you're sticking by the guns. If you do, believe me, the medium term will be much, much simpler and better, and central banks will not behave like I'm going to take all the governments off the hook. The governments have their responsibilities, central banks have their responsibilities, and that's the way it is.
Just a fantastic review, Tom, of central banking of the last couple of decades.
Can you see Jacob Frankel
back
going,
back in
well,
a central
I don't
bank.
know, I look at the dots, and I'm looking at the dispersion of the dots.
Would you get rid of the dot plot? Would you get rid of that today?
I'm not sure, but I know that forecasting. Wait. I did not have dots in Israel, but I can tell you. But I can, because dots are. What do you do with it? Now you saw it. But
would you like to join us a little bit later?
What are you doing?
What do you do with dots?
But it is important that central bankers communicate with the markets, not lead the market, not hit the market, but are part of the system. They are not even the conductor of the orchestra. They are a major player in the orchestra. Financial markets, listen what you are doing, watch what you are doing, and you are part of this interaction.
You're a deeply thoughtful man. It's great to catch up. It's been too long. Jacob Frankel there, the former Bank of Israel governor from New York City. This is Bloomberg.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
The island emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
we had some pretty tough talk.
Bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report, tonight at 9:30 Eastern. Bloomberg, context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts.
For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
The Federal Reserve has a sufficient arsenal to bring the inflation rate down.
I think the inflation is going to give the Fed the ability to go on pause.
The Fed's probably going to signal, yes, it's done, but don't expect rate cuts anytime soon.
I don't think the risk is that the Fed tightens too much, but that the Fed doesn't tighten enough.
I expect Powell to push back against all this excitement.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on this Fed Day, on radio, on television, and again at 2 p.m. Make it 1:30 this afternoon. Lots going on in economics and the linkage into a supercharged stock market. We go here, John, into this hour, into the next hour with you on the open, getting ready for this meeting, and guess what? Nobody has a clue. It's going to be
well, let's make it really simple.
You know,
let's make it really, really simple. This market has done a ton of work since the Fed last met. We've had a 10% move on the S&P 500 since early November. In the bond market, the 10 years down something like 70 basis points. I think there is only one question that matters today, TK. Does Chairman Powell push back against that in today's news conference? Does that easing of financial conditions bother him in any way, shape, or form?
Moments ago, the Bloomberg Financial Conditions Index buttressed right up. The statistic doesn't matter. It's a 0.63. But the answer is we go into this press conference screaming accommodative. We've walked away from the hope of a restrictive policy.
This market is screaming rate cuts. So by the end of today, how much daylight will there be between that median 2024 dot in the dot plot of the summary of economic projections and what the market is pricing? Because most people assume, Tom, this Fed is coming towards this market, might not meet it, but gets closer to it a little bit later this afternoon.
Lisa, what an honor to have Jacob Frenkel with us, the former governor of the Bank of Israel, all of his work, original foundational work in foreign exchange research. And as he was walking away, Lisa, you were busting his chops, and he said, we should just connect the dots. How are the dots connected?
Well, this is going to be, honestly, the nuance of how you parse all of the potential words. I think we can zoom out for a second, and we're talking about how screamingly accommodative this market is. And we're still looking at average yields on high-yield bonds that are above 8%. We're still looking at an investment-grade bond yield, all-in yield, that's relatively high. So when we stop with all of this dots and all of this, how do we look at this scenario and say, are we heading into a period of slower growth that's going to challenge companies to get refinanced? And if so, are we accurately pricing that in all the other facets of the market that are screamingly accommodative?
It's screamingly accommodative, but again, it's going to go back to the economy. And Lisa, I'm sorry, it is about the job economy. And what's today, Wednesday? Tomorrow's claims. We get another.
It's retail sales too, yeah.
Yeah, but retail sales, but we get another claims and continuing claims. Lisa will brief us on this. It hasn't cracked, and that's the nub here at 2 o'clock.
Isn't it fun to analyze every little nuance of a market that's moving in a way that we don't understand? And so we can hook on to whatever particular data point and come up with a narrative, but we're at a moment and point of transition, and we don't know what we're transitioning to.
I look, John, at the Fed meeting and what we're going to hear in the press conference, and, there's going to be some blistering questions here in nuance, and then we go on to ECB, Bank of England. They're all facing the same thing. This is all original territory for every central bank.
Rate cut roulette going into 2024. Who goes first? Most people assume it's the ECB. TK, don't worry. I keep forgetting the day of the week as well.
No,
equity futures
it's a blur.
on the S&P.
Save us with the data
Scores
check.
look like this. Happy Friday to you all.
Every day is Friday.
Futures positive 0.1% on the S&P 500. Yields lower by 2 basis points. TK 418.33 on a 10-year.
On a Fed day, we haven't mentioned oil. And again, there it is, another indication of an economy with West Texas Intermediate well under 70. Brent crude 73.72. Can you imagine a global oil price of $69? How that changes politics and debate?
It's changed a lot.
Yeah.
Certainly changed the debate around this time. I'm in the 60s. I think levels we haven't seen since Early June?
Yeah.
June, something like that, yeah.
Christian Malik at JP Morgan yesterday amending what was an emerging market demand call into something more 70, 80, maybe $90 as well. We will begin in this hour our analysis of what we will do off of the Fed meeting. We do this with Oksana Aronov. She's head of market strategy and alternative fixed income at JP Morgan Asset Management. One of your analysts, Gabriela Santos, had a spectacular dynamic chart out about what the markets do after you get a peak in yields. And the question now is cash. What are we going to do next year with all that cash once the 5% yield comes down?
So I hope everyone who was really not constructive on the cash coming into this year comes into next year with a little bit of humility off of, almost 3 years and nearly 5 years of cash outperforming bonds. And I think that rhetoric around what investors do or what markets do after a peak in rates is very much rooted in hiking cycles that were accompanied by a lack of inflationary backdrop, right? And I think it would be very instructive to look at the hiking cycle that followed the mid-1990s, where we had a Fed funds rate that kept fluctuating in the 4.5% to 6% range because inflation stayed and kind of revolved around 3%. So it is not really a given that we're going to see those ultra short rates drop, but at the same time, without a doubt, you want to have optionality in your portfolio to take advantage of what Lisa was referring to earlier, which is, this higher cost of capital finally pushing companies, pushing balance sheets to have to realize the reality that, they have to refinance at higher costs. What does that mean? Can they make it? Are there companies that should not have made it past 2020 and won't now that the Fed is not supporting them? So all of that is in the mix. And I think it's really interesting, Lisa, also that you said, we're trying to read the tea leaves to a market that we don't understand. I don't think the Fed understands what's happening. I mean, the Fed is communicating to the market that, look, we're not doing anything here at best and possibly erring on the side of being restrictive. And the market is like, we don't believe you. You're going to ease 110 points. So I think this is a rally, this wild rally we've seen in these dramatic, easing of financial conditions. We're going to see that fizzle out again as the Fed doesn't deliver these dramatic cuts because inflation remains significantly above their target, keeping their hands tied because the labor market is strong, because the equity market is doing well, et cetera, et cetera.
I'm guessing that 363 basis points and high yield spreads doesn't get you excited.
It shouldn't get anyone excited because, typically when we think about a higher rate cycle and who that impacts most dramatically, of course it is the lower rated credit operators that are hit hardest. And today we have a credit market overall that is the most lower credit quality skewed ever, with 80+% of it BBB and below rated. This is, of course, the product of many, many years, decades of easier and easier and lower rates. And so I think just like the interest rate reckoning really took its time to arrive, I think the credit reckoning may take its time to arrive, but it will arrive with some really dramatic repricings.
You started out by expressing a little bit of frustration about all of the people who pushed back against your cash call at the beginning of this year. I could sense the
Was that really noticeable?
It was really
I thought it was really
it wasn't that subtle. You were definitely coming out saying, if all those people, you should have some humility before condemning me in my calls next year. When do people start to put that cash to work? I hate that phrase. When do they start shifting it into other asset classes at a time where there still is potential distress, where you do expect spreads to widen?
So the answer to that question is, what is it that they're wanting to put it to work in, right? Because when we talk about fixed income, when we talk about credit, we make two decisions: one on the interest rate risk, one on the credit specific risk. On the credit side, as Jonathan mentioned, 360 basis points on the lowest rated part of the high yield of the credit market and high yield is just not enough compensation to really be taking this risk now. And historically, that spread is somewhere in the low 500s. So until it gets there, I would be cautious. Now, there are going to be pockets, and we've seen pockets this year, where you could do some things and enter some distressed or more interestingly priced positions. On the interest rate side, you have to really consider that What is the 10-year Treasury? The 10-year Treasury is essentially GDP plus inflation plus a long-term premium. And we may not know exactly what that long-term premium is, but we know it's not negative anymore like it was when central banks were very involved. So let's assume it's positive or maybe zero. So GDP plus inflation gets us into the mid-fives firmly. And so from a fair value standpoint, that is where that part of the curve probably will look attractive.
Wait, hold up. That's actually a pretty bold call. In other words, you're not buying 10-year Treasury yields until they go over 5% again.
Correct. But there are pockets of the market that are interesting to buy. For example, there are investment-grade floaters. So our theme coming into next year, similar to coming into 2023, is stay high quality, but do it in a floating rate manner, because this Fed is really not going to deliver these aggressive cuts that everyone is pricing in. So in the investment grade corporate floating space, for example, we're seeing yields that are north of 6%, 6.1, 6.3% on A+ rated qualities with very short maturities that reset daily, paid quarterly. That's a great trade to be. And you're not exposed to all that wild gyration, all those wild gyrations related to interest rate risk that we've seen this year. I mean, think about the fact that the Bloomberg aggregate was down 3% until a few weeks ago, and now it's up 3%. That's a 6% swing. This should not be happening with fixed income that's about capital preservation and diversification.
What is it about your rate cut call, or rather the rate cut call, that you really don't like? Size, reason, what is it?
It's both. There's really nothing fundamentally underpinning it. There's really nothing we can point to in the economic backdrop today to say this right here is why we need a Fed cut. And I think the calls or this pricing in of an aggressive cut is really based on the fact that maybe the Fed is done hiking. And perhaps that is true. We don't know. I guess the data will tell us. But just because the Fed is done hiking doesn't mean it needs to move to cutting, and certainly not cutting as aggressively. And again, history tells us that as inflation remains elevated, the Fed is not free to cut as aggressively as
Isn't this a judgment on real rates, though? That ultimately, that as inflation comes down, you don't want to get policy to get tighter. So you have to do these surgical rate cuts in response.
Surgical being the key, right? 110, 120 basis points of cuts priced in, and March going from a 10% probability to a 70% probability is not surgical. So can we see, the Fed going through a couple of cuts towards the end of 2024? Perhaps. But I've always said the more important question is this higher for longer scenario, because a 25 or 50 basis point cut is still a very much higher for longer scenario. What does that do to corporate balance sheets, consumer balance sheets, sovereign balance sheets that have relied on cheap money for so long? And I do think there's going to be a pretty dramatic repricing there.
Oksana, always enjoy your pessimism. Lisa does more than I do.
It's not pessimism.
It's
It's
realism.
realism. It's a great opportunity for investors who have the optionality in their portfolio and who are willing to really be realistic about. And by the way, that scenario can absolutely unfold without a broader recession even in the economy. So I don't think of that view as pessimistic. I actually think of it as optimistic. You can have kind of sector-specific and industry-specific recessions that can create those opportunities, like we saw in the regional banks earlier this year or in European related paper.
Lisa's going to quote you for the rest of this morning.
100%.
Oksana, good to see you. Oksana
Thank you so much.
of JP Morgan Asset Management. If you are just joining us, welcome. It is Fed decision day. Your equity market is positive 0.1%. Yields are lower by a couple of basis points, 417.76. The decision a little bit later, together with projections, TK, the dot plot that you know and love, and then it's on to the news conference with Chairman Powell.
Well, we really haven't talked about the news conference other than, he's going to step lightly as he always does. Probably it'll be a record number of prepared statements. But on the news conference, I just think he's going to throw it ex post into the next sequential set of Fed meetings. He's got to stagger out and try to get to a March meeting. And there's not enough talk about that.
Get an assessment of inflation, whether he thinks it's sticky or not. Push back against some of the hope that these disinflationary trends
He's going to push back
continue.
against the word hope. That's the key.
It's actually a really interesting meeting, It really is. Coming up in about 20 minutes' time, we'll catch up with the brilliant Claudia Sahm, the former Fed economist, reacting to some data and looking ahead to the Federal Reserve decision later on this afternoon. On the Sahm rule, Claudia Sahm herself from New York City. This is Bloomberg.
slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Today, the Fed decides.
We're talking rates. We're talking inflation.
Without a recession. That's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg.
If we see stability in inflation, and then as we move the calendar page into 2024, we see a little bit of an uptick, I think that could force the Fed's hand to take one final rate increase to convince the market that 3 is not the new 2.
3 is not the new 2. That was Lindsay Piegza, chief economist over at Stifel. That right there is your pushback going into Chairman Powell's news conference a little bit later on this afternoon.
Our team is gifted. That was the quote of the day yesterday. And they absolutely nailed it. And I'm sorry, John, for everybody out there, particularly those looking for Dow 40,000, Piegza is really pushing back against the zeitgeist. She mints no words
big
about
time.
it.
Let's keep going over it. We have had, since early November, a 10% move on the S&P. Tom, we've been pricing in 100 basis point plus of rate cuts. And Lisa, on what is the conversation we need to have? Certainly, the direction of the data is encouraging, without a doubt. But do you think Chairman Powell could sit there today and give a ringing, singing endorsement of what we've seen in this market over the last month?
Chair Yellen did. She said that actually it's going to be easy in the last mile. So he could just say what she said.
Can you imagine if he did repeat that? What Chair Yellen, Secretary Yellen, said just yesterday at that Wall Street Journal event? If he repeated what President Biden, Vice Chair Biden, said on Friday after the payrolls report, that is a ringing endorsement of where this market has been.
He's in a tough position, but I'm going to go back to core theory. This is Richard Timberlake of the Georgia School, Alan Meltzer, Carnegie Mellon, a guy named Bernanke teaching at Princeton. Guess what? They're ex post. The liberals, the conservatives, they all agree. They go after they have to wait, and the job market hasn't given them that signal.
And the stock market does not wait. It's an anticipatory asset class trying to get ahead of it all. Yeah, of course. Of course.
Expectations out there and the way they go. The only thing I'm waiting for is to find out if we'll watch anything at home besides Netflix. And we had Netflix.
Yeah, what's your new show? What is it?
That's not on Netflix. It's on Apple. No One's
Apple.
Slow Horses. Okay. It's Gary Oldman.
It's about
it's
spies.
Brilliant. It's spies. It's scary. And it's really, really well done. I rarely watch this stuff. Ed Ludlow's glued to it. He's going to give us a brief on the bombshell for Hollywood overnight. This was huge. It's off the radar, folks, with our talk of Fed. But Ed Ludlow getting out front, Netflix shows that 8,000 of their movies nobody watches. And we all watch the same 200 movies to billions of things. How does this change the technology of entertainment?
It changes it because it gives us transparency on the what that we're watching, and it's in close proximity to the writers and actors strikes that we just had, right? We've all been asking to know for years who is watching what on Netflix and in what volumes. We finally got it. It was so interesting to see overnight the market analysts and all of the audience complain about the data we finally got. But it does show that basically the spend that Netflix is doing internally on its own content, the degree of watching on that versus the titles that they're buying in from others, and then also tells the actors, are they being paid enough for the work that they've done in the streaming context.
Okay, just a general question, and I'm going to go back to the winter of 1964 when we knew the Stones did this and the Beatles did that, and it was like a normal industry, and maybe now they're going to get normal as they show us the performance of all this. Are they going to be profitable as an industry? I know Netflix is leading the way, but when you look at the analysis overnight, is there any indication of future profitability?
Well, at least the data can kind of guide Netflix in what people are watching in higher degree or volume and geographically where they're watching it, and then decide what not to spend on. You know, for the last 18 months, there's been a question, full stop, if the streaming model where you make your own content and put it on your own platform is ever going to be profitable. And everyone has followed suit, Disney leading the way in the sense of the big pullback in the commitment to spend. Netflix has that hybrid model, right, where it has to keep churning out large libraries of content, both its own and others, to keep the eyeballs coming. And when you look at those top watch lists, it's interesting to see it dominated by so much of what they produce themselves.
I would watch a dramatic series about Elon Musk, and I would be curious about where we are in this moment, what the episode would look like with some of these potential recalls coming out, given the fact that Tesla just filed a new recall affecting 2 million vehicles, having to do with the self-driving system. How big of a concern is this for them?
Well, I think, you tell me, guys, I think the stock's down 1% in pre-market. I'm coming to you from the metaverse, so I don't have a Bloomberg in front of me. But it's a recall in name only, insofar as, yes, 2 million US vehicles are impacted. It impacts all generations of all Tesla models. But the fix is an over-the-air software update. And there is a argument to say, well, how fantastic is it that Tesla, after a multi-year investigation by NHTSA, can simply fix the issue by the press of a button by the consumer or the customer and patch it with software pretty quickly. But clearly, NHTSA is one of just one regulatory body of many regulatory bodies looking at Tesla and Elon Musk's other companies. And this is part of a multifaceted approach to the future of self-driving. What is really important, Lisa, in this case, is this is autopilot, the basic driver assistance that this recall relates to. It does not relate to full self-driving beta, which is the higher degree of autonomy that Tesla currently has in testing with trusted testers and kind of long-serving customers.
Ed, you cover this, and this is my real question. Are you surprised by how much skepticism there is for auto driving, considering how not great most drivers are?
I am surprised in the sense that here in San Francisco, it's more commonplace to see a legit robo-taxi, Waymo being the prime example on the streets. Cruise recently lost its license. But the end market feedback is that people really like these products, and therein lies the regulatory debate. Who are they regulating for and on whose behalf? It's incredibly important to state there have been fatal crashes where safety investigators have found that crash was either directly or partly caused by the use of autopilot and in some cases full self-driving beta. But those are in very small cases, and the degree of accidents on our roads in the US linked to those technologies is significantly lower to those linked to human error. And again, if you're a Tesla customer or a Tesla investor or you're Elon Musk, you would say to the regulator, who's benefiting from this? We feel like we've improved safety on our public roads relative to, as I said, those accidents caused by a human mistake.
Ed, we've had a bit of a reality check for the industry in the last 24 hours, not just on this front, but also for Ford. Ed, you and I will talk about this again a little bit later this morning. What was your takeaway from what Ford had to say in the last couple of days?
The demand pocket of early adopters has been and gone. You know, it relates to the average selling price of an electric vehicle, that pocket of the market that's willing to pay a higher price to claim that they were first to have the latest electric vehicle technology is gone. And the demand picture for 2024 is very much in question. You know, it's really an economic story. After your mortgage payment or your rent payment, usually financing of a car, lease or otherwise, is the most expensive outgoing from your household. And so now there's real tangible evidence that that pinch is coming. What startled me about Ford is that November was the best ever month for the F-150 Lightning. And literally 4 weeks later, they've cut their entire outlook of production for the next year. So what is it that they know about the consumer that we don't?
Interesting. Ed, thank you. Looking forward to catching up later. Ed Ludlow there on the West Coast in San Francisco. TK, one of the headlines of the week. Ford cutting production basically in half for the F-150 Lightning. plug-in pickup truck.
You talk about the shocks of 2023, and I get it's engineering, but mostly what it is about marketing, studying your end consumer. And as that alludes to, I really wonder if they have a knowledge about what's really going on in the showroom. What's going on during a football game when you see 7 car ads in a row? What are people thinking? And I don't have any strong opinion on
Well,
this.
based on that production target, Tom, I guess they've found out pretty quickly, haven't they? Coming up in the next hour on Bloomberg TV, Kathy Jones at Charles Schwab, Bob Michael at JP Morgan, Jim Karen at Morgan Stanley. Fantastic lineup to anticipate a Federal Reserve decision a little bit later on this afternoon. Chair Powell at a news conference, a statement, and a ton of projections, the dot plot. We'll break it all down for you a little bit later. Bloomberg surveillance, the Fed special later on today. From New York City, good morning to you all. Equities just about positive on the S&P, coming off a 3-day winning streak from a beautiful New York. Can we make it day 4?
On the product may read made in the USA, but the sign on the CEO's door often says made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Surveillance for exclusive. Bramall excited about PPI. We're going to get that coming up here. Underplayed as it is. Good morning. Farrell off to the 9 o'clock show. The Fed decides this afternoon. Farrell head for the nap after the the open, as he is wont to do. But we've got some economic data coming up, and
Yes.
PPI is not CPI, is it?
It's the producer price index, and I think it's been underplayed. If you do get some kind of surprise here, could that kind of lead into the market? Let's head over to Michael McKee.
Let's go over to Michael McKee right now. Claudia Sam coming up, but first McKee on our disinflation.
Well, we're getting a little bit of a surprise, not a huge surprise. The PPI final demand month over month comes in at 0, flat reading. That's after a 0.5% decline the month before in October. Core comes in at 0.0 as well, and that's lower than the 0.2 that was forecast. So leaves us on a year-over-year basis at 0.9% PPI for final demand, and the core on a year-over-year basis is 2%. So the Fed can say at least one inflation measure is at 2%, and another is below that. Now, I tend to look at, to say the real core is ex-food, energy, and trade services. That was up just 0.1 as forecast, lower than anticipated, and then on a year-over-year basis, 2.5%. So at this point, PPI is performing as it has and coming in significantly lower than CPI, but I'm sure, as Claudia will tell you, the two don't have a direct relationship.
Mike, don't go away. We want to come back to you. Folks, markets are moving on this. It is, as Mike says, little moves, but all the little moves seem to be disinflationary. Equities pick up a little bit. Futures up 8, Dow futures up 47, but it's in the bond space. Lisa, you noted 4 basis points instantly. We come in on yields, particularly the 2-year Fed decides yield.
You know, you're seeing this consistently. I think that you brought that up, and it's a really important point, Tom, that all of the cuts are in the same direction, and it is a disinflationary one. We can now see about a 40% chance of a rate cut come March by the Federal Reserve ahead of a meeting where Fed Chair Jay Powell, Tom, will tell us that they're not planning to cut rates.
Mike, how does the Fed use our business inflation, our PPI, our producers' inflation?
Well, they're looking at it as part of the overall trend. It's what Jay Powell describes as sort of the accumulation of evidence. It isn't, as I said, a direct relation to the CPI. There are a lot of middlemen in between there that adjust the prices, but it does suggest that conditions are in place for continued disinflation because input costs are going down.
Does this really speak to margins continuing to expand because CPI, consumer prices can expand faster than the producer prices that a lot of these companies pay?
Well, that's what you get out of that super core PPI that I was talking about that includes trade services. That's wholesalers and retailers, and the way the Bureau of Labor Statistics calculates that is by looking at margins. So if margins are expanding, it definitely suggests that costs are lower for them in many categories.
Michael McKee, thank you so much. And again, leading our coverage and in the press conference today with Chairman Powell, Michael McKee in Washington. I was on the stage at Marrakesh with Geeta Gopinath of the International Monetary Fund, and we were talking, she was some emotion, about one of her professors at Harvard. Her name was Claudia Golden. Claudia Golden changed American economics. There's no other way to say it. She is the one that pushed forward and said, we're going to do intelligent research, forceful research, is one of the leading women a generation before. And it was extraordinary to see the Nobel Prize for Claudia Golden in Stockholm this week. Part of that leads on to Stephanie Kelton's work in modern monetary theory, all the rage a few years ago, and certainly very, very valuable and controversial. And then from Claudia Golden and Stephanie Kelton, you can drag yourself forward to the profound 2023 of Claudia Sam. She has been front and center with this mystery of a non-recession. Her work on recession in Michigan was just extraordinary years ago. She is with Sam Consulting on this Fed Day. Claudia Sam, I want you to talk about what you got from Claudia Golden. The idea here that it wasn't going to be nice, we were going to play hardball, we're going to do first order research like you did at Michigan. Tell me what Claudia Golden meant to you.
Claudia Golden's an absolute leader in the field of economics. She's a scholar, she's a hero to a lot of women and frankly men in the profession. And it comes into the real world. She's one economist that really said, hey, we got to think about women in the workforce and we saw this year women's employment rate for prime age women hit an all-time high, right? So it's not just about the theory and the scholarship. It's about, let's make this happen in the real world.
This goes to the American mystery of a non-recession. You've provided leadership on this year. Do we misjudge women in the economy? Do we misjudge technology in the economy, which means we have to have a humility about the SOM rule in 2024?
So we absolutely, I love that this is Fed Day, but we have overplayed what the Fed means to this economy. We need workers back, not fewer customers. The Fed can only do the latter. We have seen workers come back. We have women, we have Black men, we have people with disabilities, and to your point, productivity. I mean, this is the holy grail of prosperity. We've had some pretty good productivity numbers recently, and frankly, there are technologies in place. Like work from home did a lot to help women who were on the sidelines, were those with disabilities. I mean, we really have some great stuff going. We just got to keep pushing.
Claudia, you were saying that the Fed is not the end-all, be-all. So then why are you so excited for today? What are you hoping to hear from the press conference?
Oh, I love the Fed. So Fed Day is always a fun day for me. So I feel like the soft landing's in the bag for next year. 2% inflation, unemployment stays below or around 4%. And but my biggest risk factor outside of politics in the economic space is the Fed. And frankly, what I worry about is them confusing markets. And I'm really not fully emotionally prepared for the summary of economic projections this afternoon, because I don't think it's going to give markets clarity. They're all over the map on their cuts. There's no way we're getting first quarter cuts from the Fed. And I worry that they're going to create enough uncertainty that something breaks. We've been lucky so far. Nothing's broken. And that could come back and put the soft landing in some danger.
What would break? I mean, what we've seen is markets becoming more accommodative, a stabilization in benchmark bond yields. Where is this potential for breaking coming from on the heels of Fed communication?
Right. So if I could predict a financial breakage, I could make a lot of money. Right. These don't come in an expected way. I think Silicon Valley Bank was that was a scary moment. Right, the Fed set up an environment with interest rate risk, and then you had a bank that had made incredibly bad decisions. So that kind of came out of nowhere in a big picture sense, and yet we got it under control. The Fed stepped in, regulators stepped in. So, I have a lot of faith. Again, this is a risk that I see, and it's a pretty low risk. But we've had a pretty good run of the Fed, not things breaking in financial markets, and frankly, I'm a little surprised. I'm thankful, and I think we're on the right path. But the Fed needs to stop injecting uncertainty. They got to get the message straight.
Although it's unclear to create certainty at a time that's deeply uncertain. This is sort of the conundrum for Fed officials and for economists and even for people in the market. You were saying that next year the soft landing seems to be in the bag, but the biggest risk factor is the Fed. What is the bigger policy error that you see them committing? Would it be cutting too soon or cutting too late?
I honestly don't think the Fed matters much next year. This disinflation has not been about the Fed. Jay Powell is not landing this plane, right? This is not about the Fed. Now, one thing I would really like to see today is that Jay Powell articulate that they're going to go slowly and really get people off this first quarter call. They're just not going to have enough data by March, and they're going to be little c conservative in cutting because they don't want to have to raise again. They don't want to make it look like politics.
Right.
It's an election year. So but there's been a lot of communication issues. You've got so many FOMC officials out. Frankly, I think they should limit their airtime. Sorry. But, I think that's where there's been some confusion. But when I listen to them, I'm like, they're going to wait.
Think how we feel, Claudia.
You get to listen to a lot. But I think they're going to get it together. Right. They know what they need to do.
Claudia, out on LinkedIn today, you allude back to the Volcker fantasy, the idea of Powell being like Volcker, and you even take it back to the emotion that no one wants to be Arthur Burns. He had the pipe smoking, and what was a cloud of smoke telling us in the meeting. Tell us what we want to avoid that Arthur Burns did decades ago.
There were two things that Arthur Burns did that are at least seen as a mistake among monetary policy officials. One was whenever unemployment started to drift up, he cut. And then inflation came back even stronger. And there were a few episodes of this, and that meant when Volcker came in, there was a real mess. They had to cause a severe recession. Jay Powell has said on record that Volcker is his hero. right? And the second thing that Burns did that actually lines up with next year is Nixon really pushed on Burns to cut those rates. There's no way they want to do that this time.
Let me channel from John Farrow this morning. Is Chair Yellen and Vice Chair Biden, are they pushing Powell to cut rates?
No. This White House, I mean, this is not the Nixon White House, right? They know better than that. I mean, you have the former vice chair of the Fed running NEC. You've got the chair of the Fed running the Treasury. Like, there's no way, right? They know better.
Claudia, congratulations on your impact this year. May a non-recession trail you into 2024. Dr. Sam is with Sam Consulting in her absolute metric of original research, the Sam rule, front and center for so many in academic and market economics. Remember Matt Lazzetti, like a year and a half? He's on the show this afternoon. Matt Lazzetti. There's going to be a recession, but not soon. That was the call of 2022.
And now you have people gaming out whether we're going to get a recession at all, right? Saying that basically there's a no landing scenario or a soft landing where we avoid any kind of pain. The thing that Claudia Sam was talking about there is, how does the Fed give the market certainty, or at least take away some of the uncertainty at a time where they're not sure about the trajectory also?
If I'm in a press conference, and I'm not, folks, it's like a real job. I'm McKee, real job. Tom Keene, not real job. But I'm going to raise my hand and go, hey, Chairman Powell, how about that spike we see in bankruptcies? I mean, because that's what a lot of America's feeling. You mentioned the charge card debt, but actual recorded bankruptcies, which I think like claims is countable, is a big deal.
Well, and that sort of goes to the question of why is the surprise to the downside for inflation consistently? Is it just because of the post-pandemic effect that you've been talking about, Tom, or is this being driven by a real price pushback by consumers, by corporations at a time where there is a bit more weakness?
Yields move on PPI, 2-year in 4 basis points. The Standard & Poor's 500 advances slightly, up 8. Up 0.2%.
One thing that you've really highlighted, Tom, is the financial conditions index that we have seen really become more accommodative.
Yes, it really is.
Deutsche Bank pointing out this morning that it's the most accommodative since the Fed first started hiking rates last year. This is part of the concern, right? Is this a problem for a Fed, or is this fine because there is weakness that they see coming down the pike that will do some of the work for them and it will become apparent to markets?
Well, again, and it's so, folks, let's line this up. Let's get out front at 2 p.m. today. I'm going to show up. I didn't know it was Fed Day. And John
You're going to show up. Newsflash, banner.
Can you cancel the walk with vet bill? I said, yeah, I can do that. But we're going to show up, and there's the real economy dynamic. There's the financial economy dynamic, which financial television and radio is addicted to. And then there's also this whole labor society where Chair Yellen is truly globally the expert. And they're all souped in off of a post-pandemic and a post-ginormous stimulus. And Ed Yardeni, S&P 6000, in his note yesterday said, can everybody wake up and look at the fiscal side of things? Will this chairman address that in the press conference?
The fiscal side of things, sure. There's a question about what bond vigilantes are worried about the deficit. But then on the fiscal side of corporate balance sheets, what you're seeing is a lot of strength still. Something you've pointed to at a lot of the bulls out there. One area is home builders, in particular, that continue to build homes, continue to sell them at a time of scarce supply, especially with people locked into 3% mortgages.
Futures up 7, Dow futures up 44. The VIX an 11 print yesterday. Nirvana print late in the afternoon, 12.26 right now. The Fed decides. We'll do that at 2 p.m. Coming up, must listen, must watch on real estate. Drew Reddy, Bloomberg Intelligence. Good morning.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this
this role, it's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Given the trajectory of OER and shelter prices yesterday, he has to push back just a little bit on the amount of rate cuts that have been priced in for 2024 and how quickly. I think the March cut is the issue, not so much the 110 basis points of cuts. I think it's okay for the market to just stay on pause so we don't. What I'm excited about in 2024 is to not hang on every single word that the Fed is saying, at least for the first half.
I think we can all get behind that. That was Gargi Chowdhury, BlackRock, head of iShares Investment Strategy Americas. Did you just bark, Tom?
Yeah, no, I barked. She just was on. She was like fired up about, here's what you need to do next year.
Yeah, deploying cash, that concept, especially as people get a little bit more confident about the concept of a soft landing. You could see a bit of nudginess, to use your phrase, in the market this morning. Not a lot going on, but still a steady bid. S&P futures crossing the 4,700 line, up 0.2%. A bit of euro strength, again, basically flat, 107.95. That 10-year yield coming lower, in addition to the 2-year yield coming in after the PPI data, once again, just hints of disinflation.
It popped into my head. Do you think Chairman Powell will address, one number I've seen is $6 trillion of liquidity that's out there looking for a warm spot? I mean, is that the fundamental issue in this market? It's just all the cash that's out there?
It's a buffer, and I don't expect him to address it because he's not an investment strategist, but definitely it has been adding to the financial conditions continuing to ease. One share that I wanted to point out, talking about the post-pandemic economy, is Pfizer, which is struggling because people evidently are not getting their booster shots and their additional vaccinations. And you're seeing that disappointment play out in some projections, shares lower by 6.7%. They came out today and said that the overall sales for next year will come in below the analyst estimate of nearly $63 billion to $58.5 billion to $61.5 billion. And this sort of points to the haves and the have-nots of the biopharmaceutical industry at a time where some are stuck with the pandemic and some are moving on to the weight loss drugs.
And maybe this also falls into the health disappointment. Gargi Chowdhury mentioned that, and others have mentioned that health is a comfortable place to be that's been, somebody said, a laggard. And I wonder if off of COVID, Pfizer joins, what was it, the lovable laggards from 2 hours ago?
And where do they come up with the new booster, if you will, as you look to a post-pandemic economy? Meanwhile, one area that's been flying is the S&P Home Builders Index, up more than 60% this year, with demand for home sales improving across all U.S. regions in November. Drew Redding of Bloomberg Intelligence writing, quote, though the pace of sales in November was generally below the frantic rates of 2021 and 2022, most markets exceeded 2019 levels, which represented a more normalized period. The distorted world of home building and home ownership. Drew joining us now for more. Drew, how do we understand this frenzy in home building that on one hand could be viewed as strength, but on the other, just a lack of other options in the home market?
Well, I think you framed it perfectly. I mean, one of the reasons why the new home market is doing so well compared to resales is because in the resale market, there's not a whole lot of inventory. We have started to see a little bit of an uptick now, but looking back historically, we're still at very depressed levels. The other thing you have to recognize is that the builders have been able to help buyers meet their monthly payments in a way that the existing home market can't. They've done that through financing incentives. So think about rate buy down. So when someone's going into the existing market, right now they're seeing something about 7%, low 7% range. Someone coming through a new home community is probably going to be getting a rate in the 5.5% range. So when you couple that with the fact that new home prices are down about 15% from peak, and you factor in a 5.5% rate, the monthly payment on a new home is comparable to an existing home, and that's not something we've seen historically.
Drew, it raises this question. If mortgage rates fall, will that be a good thing for the home builders or a bad thing, given that there is competition in the existing home market?
Yeah, so I think if rates come down to the 6% range, we're thinking next year we get somewhere around 6.25%, 6.5%. We think that increases activity throughout the housing ecosystem, which we think is a good thing for the builders. Certainly the market share situation won't be as strong for the builders. Right now, the new home market accounts for about 30% of listings for sale. So we would expect that to trend a little bit lower, but we think that the more activity you have within the housing market is good for all.
Drew, my experience is media people looking at housing, rent, multifamily, REITs, and the rest make up, 90% of them are within 3 zip codes on the island of Manhattan. You are expert at looking across the country. What's the biggest distortion we have in our study of housing that we just get wrong because we live in New York?
Yeah, that's a good point. A majority of home building in the U.S. is concentrated in the South, primarily in the Southeast and markets like Texas. And what we've seen there is that job growth has been stronger. There's been a lot of out-migration since the pandemic into those southern states. So we've actually seen demand hold up comparatively well. When you talk about those higher-priced markets like those out in the West, those were some of the hardest hit during the pandemic because obviously when rates rise, it really amplifies the unaffordability of those markets.
Well, then what do the builders do? Do they build less houses outside San Francisco, outside Los Angeles, outside Phoenix? Is that the normal reaction?
So in the West and primarily in California, it's still somewhat of a small portion of overall new home demand, but you do see the largest concentration for the publics is in the Southeast and Texas. That's really where they're concentrating, where you see a lot of builders really starting to expand their footprints. They're going to continue to build where the demographics support it, where population growth is and where job growth is.
Lisa's thinking about moving to Florida. I mean, it's like a study for next year as well. Has Florida peaked?
Well, there are certainly some markets along the coast that are coming off the boil a little bit where prices have risen the most. But by and large, some of the largest markets for the builders, like a Jacksonville and Orlando, are still doing relatively strong. It's some of those markets on the western coast where prices are coming down a little bit. The other concern that you see in some of these hotter markets is single-family rentals. That's one of the concerns that's kind of come out there a little bit more recently is if the economy starts to slow and you start to get more of this inventory from short-term rentals coming to the market, what does that do to prices? So that's something we'll be watching in some of those markets as well.
I always learn something about myself from you, Tom.
Well,
I didn't even know that I was...
You'll love Coral Gables.
Okay, you think so? You can see me there? In Boca. Just, Drew, I'm curious, as you look forward, whether you're expecting home prices to go down substantially as you do see a market normalize. It might be a good thing for activity, but it will also be a time of price discovery in a huge swath of the market that just has not had that because nobody's been moving.
Yeah, it's a good point. And so we did an analysis, and right now with mortgage rates at 7%, just to give you a kind of framework here, home prices in the existing market would have to fall about 30% for monthly payments relative to incomes to fall back within the long-term averages.
30%.
So it does highlight the distortion in the market.
Right.
Now, do we expect that to happen? We don't really think that's likely unless we start to see rising unemployment and a sharp turn in the economy, because even if we do get some inventory coming to market, that still historically has provided a buffer and a floor to home prices.
Drew Redding, thank you so much. With Bloomberg Intelligence there on something we all care about, which is to say housing. At least, I make a joke about Florida, and it's booming, but, some of the people that are native to Florida are actually moving out because all the fancy people are moved down, and I get whispers that even Orlando's being priced out.
Yeah, especially now that it's become the Wall Street of the South or something, the warm Wall Street. What are people calling it exactly? Sitting
I
leading
can't
the charge?
remember. You know, I'm not in charge. We're trying to get the show moved down there next year. We'll see what we can do.
I can't picture you in Florida.
No,
Sorry. Would you wear a bow tie on the beach?
No, it's not been successful. I gave a speech in Orlando once, and we're driving to the hotel. I think Ian Bremmer was there. And I'm looking at the window, and there's the first alligator, like next to the road.
Yeah.
And then like a mile on, there's another damn alligator. By the time I got to the hotel, it's the worst speech I ever gave. I was totally. I'm looking around my hotel room. I'm looking under the bed to see if there's a damn alligator there. Seriously, Ohtani of the Dodgers, it's just implied he moves to Florida when he picks up his $600 gazillion down the road. And this home builders thing, I've been wrong on this for 30 years. Let me say this. I mean, the boom, as you mentioned, the boom that Lennar and Toll Brothers and all.
To be fair, nobody got this right. Nobody
Yes.
understood that you jack up mortgage rates up to a high enough level and nobody moves. And suddenly there's no inventories. So home builders come up with some more creative financing and offer an alternative market that goes gangbusters.
You know, Brammel's lifting the market here, folks. Where are we? We're 8:55 Wall Street time, getting ready for our Fed coverage, 1:30 today. You know, I'm thinking Dow 40,000 by 2 p.m. I mean, I'm sorry, folks. There's a bid to the tape, and I can see it off PPI, but also Brammel's comments is
Are you really scared of alligators? Is that really the deal breaker for you?
Wait, excuse me. Are you scared of alligators?
Well, I mean,
Yeah,
is it
no,
sort of,
no.
you know, I don't know.
Are you kidding me?
You almost lost it. You almost said something else.
Yeah.
Coming up at 1:30 p.m., more alligator
Sell it.
discussion. Bloomberg surveillance, the Fed
Diane
decides.
Swank's not afraid of alligators.
We're also going to be speaking with Priya Misra as well as Bill Dudley.
Will the ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimates, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
This is Bloomberg.
Is it the calm before the Fed storm? Live from New York City this morning. Good morning, good morning. We are just about positive on the S&P on a 3-day winning streak, about to make it 4. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Fed Chair Jay Powell about to take center stage. Following double-digit gains since the last meeting, investors look for signs rate cuts are coming next year. We begin with the big issue, a great big pivot party.
It's a Fed pivot party, and we're all invited.
A pivot.
Dovish pivot.
The market has really been very eager to price in this eventual pivot, towards easing.
Traders right now are pushing this dream of 4 rate cuts next year.
Markets have been celebrating this idea that there's disinflation in the pipeline.
We're in a slow growth, disinflationary environment.
Inflation's coming down faster than many thought.
Things are at least directionally on track for the soft landing.
The market has been overly optimistic on when the Fed has cutting.
The Fed is likely a bit uncomfortable with where the market is currently priced.
They will definitely fight back.
Push back hard on cuts next year.
On where the market is, where it's gotten a little bit ahead of itself.
We still need to respect the fact that the last mile of the inflation journey is often the most difficult.
They have to keep some vestige of this tightening bias or hawkish concerns about inflation in place.
It remains to be seen whether that pivot this time is right.
Let's have that conversation right now with JP Morgan's Bob Michael, Kathy Jones of Charles Schwab. Kathy, first to you. Will Chair Powell validate this great big pivot party?
Yeah, I think I would agree with the pushback a bit concept. I do think that the dots will indicate that the Fed is more likely to start cutting rates in the middle of next year than the previous set of dots that we got in September. So we're optimistic that there will be a pivot, but we don't think that this particular meeting will be anything more than a hint rather than a confirmation. So I think they'll drop some of the language that talks about the need for further tightening, so that will be a hint, and the dots will move a bit lower. Maybe the dispersion about the dots will come in a little bit. But I don't think that this is going to be where Jay Powell gets up and declares, oh, by the way, we're ready to cut rates.
Bob, let's talk about the moves in this market we've seen since the last meeting. Equity stocks up something like 10% on the S&P 500. Bonds have rallied hard. Bob, do you think that's going to bother him or the committee in any way, shape or form?
I think it will bother him a little bit because I think some of the measures of inflation they're looking at are probably a bit high. I don't know how he's going to do it, though, because how do you maintain some sort of hawkish bias and push back on all of this if it's been 5 months since your last rate hike? It's not credible. What we're looking for is how many rate cuts will the dots show are expected next year, and we're also looking for their year-end inflation expectation for 2024. Do they leave it at 2.6 or do they bring it down to 2.25?
Bob, you nailed it. How credible is it? Kathy, how credible is it if your 2024 dot is showing more cuts than when you last met?
Yeah, I think they have to take out the idea that there's any more rate hikes in this cycle. The market doesn't believe it, and there's really no need for it. When you see what's happening with inflation coming down, there's no reason for the Fed to keep tightening at this stage of the game, particularly through rate hikes. Again, they're still doing quantitative tightening. There's still enough tightening in the system, I think, to keep that inflation trend coming down. So it is going to be a tough balancing act. I agree with Bob. It's going to be very difficult to communicate the right message.
Kathy, where would you expect that median dot to be in 2024? I've heard anything between 2 and 3 cuts at the Fed. What's your view?
Yeah, we're looking for 3 cuts, but we're not looking for them to start until mid-year. So I think the market has 4 cuts priced in, starting as early as March. We're pushing it back, looking more like July, perhaps, and then 3 25 basis point cuts in 2024.
Bob, are you on the same page?
Yeah, it's the safe thing to do. Just put in there 3 cuts acknowledge the improvement in inflation, acknowledge that things are slowing down, tell the markets that you're going to be responsive to it, and it's pretty close to what's priced in. Again, something like 2 dots, 2 rate cuts, they're just not credible.
Chairman Powell, and that decision about 5 hours away. Mike McKee down in Washington to break it all down for us with a preview. Morning, Mike.
Good morning, John. Well, we had our last piece of data come out before the Fed meeting began, and that was the PPI, Producer Price Index comes in.
Again, as you can see, from the point we purchased Bitcoin, it moved up 1%. So right now I'm placing an order to sell, it's stop loss, this position if it will reach the level 41,250. Okay, let's place stop loss 0.5%, 41,250. Okay, let's change color. So for newcomers, they will understand probably. If not, they will see at least a different color. Blue color we purchase. This color will be replace stop loss. So we're already 500 pounds in profit. Okay, guys, stay safe. Let's see what's going to happen.
With Kathy, I agree. I think the stars come closer together. They tighten up a little bit, but my bet is that what we'll see is still 2 rate cuts, which is what the dot plot for 2024 showed in September, because if they go beyond that, then they have to explain why. And I don't know that Jay Powell is up for that today. The red line is where, by the way, the market thinks they're going to be. The green line is the median as of the September number. And then what they got to do is put out a new summary of economic projections, which will give us their views of unemployment and inflation. Will they lower those significantly? If they do, then that sets up a question of how does that compare with the dot plot expectation for interest rates to perhaps go down? And people will be asking Mr. Powell to kind of put the pieces together. We'll see what he says. And of course, now being as it is Fed Day, I've got to ask Bob Michael, what's my question of the day?
It's over to you, Bob Michael.
Okay. And Mike, if he tries a hawkish bias, don't snicker out loud. Lower your head or you're definitely going last. I think you have to ask him how the committee's thinking on the long and variable lags has evolved, because effectively we are in the perfect soft landing right now. If you look at unemployment, we've had 24 consecutive months at unemployment at 4% or lower. And if you look at inflation, look at today's PPI, 2% year over year, bang on their target. And if you look at core personal consumption expenditures, you're looking at the last 3 months annualized at around 2.4%, way down from 6.6%. If they don't start cutting rates soon, then they're leaving the high real rate environment, that whole structure in place, even though we're already in a soft landing. So I'd like to know how their thinking on those long and variable lags has evolved.
Well, we'll ask him whether they're close to making a policy mistake or something like that. But I think Bob has pretty much, John, nailed it there. Everybody's going to want to know the justification for, the timing of, and the magnitude of rate cuts now. They seem to have crossed that Rubicon.
Mike, all looking forward to your coverage a little bit later. We all are. Mike McKee there down in Washington, D.C. Kathy, let's build on that. Your question for the chairman in that news conference, what is it?
I'd like to know how the committee is thinking about quantitative tightening in an environment where they'll be cutting rates next year. So I know they've said that they plan to continue QT even as they cut rates, but that sets up a whole dynamic that risks having another market incident and or just being at cross purposes, you know, tightening on the one hand, easing on the other hand. So how is that going to work? How much thought has gone into it? What are the tools they would use to manage it? And what is the optimal size of the balance sheet?
Kathy, it's such a good point. Bob Michael, have you given that thought, the sequencing of things? If they start to engage with rate cuts next year at whatever date, where does that leave QT?
I think they leave it running in the background. I think there's a feeling there's a lot of money still sloshing around in the system. It's gotten into places probably where it doesn't belong. Some of those bubbles have started to burst over the last couple of years, but the size of the balance sheet is well above anything they would like to see it. So I think they'll let it run, and then by the end of the year, they'll start to taper it down.
Well, let's get to levels in the bond market. 2-year peaks at 5.25, 5.26. The 10-year peaks north of 5%. We are way off those levels. 10-year right now, 4.16. 2s, 4.67. Bob, you've been bullish to a lot of this year on this bond market, looking for this to rally. It has done over the last month. What do you think we're going back to right now, Bob?
I think you've got to start pricing in a lot of rate cuts next year. And the market is always tentative about changes in cycles, whether they're entering a hiking cycle or a cutting cycle. And the reality is, once they start cutting rates, they do a heck of a lot. We've looked over the last 40 plus years, the last 7 hiking cycles, and we've looked at the return of the bond market the 2 years following the last rate hike. And bonds outperform cash by 13%. And the average rate cut is about 500 basis points. And if you go to the couple periods where you didn't get that, the 95, 97 period, that sort of soft landing, you got 175 basis points in rate cuts. And if you go to the pandemic, rates had only gotten up to 2 3/8%. So you got 2 3/8% in rate cuts. That still averages to about 200. So once they start going, we expect a lot of rate cuts, and we expect excellent bond market performance going forward.
But when you say a lot, do you mean 200?
I think at a minimum. I think that they get down to the 2.5% to 3% range. Take zero off the table. Every conversation I have with clients, everyone wants to know, well, if they start cutting rates, does that bring us down to the zero lower bound? No, it doesn't. We're well beyond that. That was the last cycle, and hopefully that generational episode doesn't occur again for a few more generations. Something more reasonable is to take half of the rate hikes back. Think about 2.5%, 3%.
Kathy, what kind of economic weakness would you expect for the Fed to deliver 200 basis points of cuts?
Well, I think the first thing is you'd have to see the labor market deteriorate more than it has. And, you know, it probably will soften up a bit. We'll have to see unemployment above 4%, closer to 4.5%. Now, having said that, I know that a lot of people at the Fed will push back and say it's not necessary in this cycle because unemployment, the Phillips curve has been broken, and that's unimportant. But I think that in this stage of the game, if we don't get unemployment above 4.2%, 4.3%, it's unlikely the Fed would cut that much. But you do have to look at then the inflation side, which I agree with Bob. Inflation's coming down. The Fed will be delivering some rate cuts because, simply because inflation is down and those real rates have some room to come down. I think 2024 is really about real rates coming down.
Let's get into that, Bob. Let's finish there too. Is this a call on real rates coming down and disinflation continuing, or are you making a call on a hard landing? Which one is it?
It's a combination of both, but certainly, even if we have a soft landing, not a hard landing, if you take the Fed at its word, and they're saying that the long-term neutral R star is 50 basis points, they're telling us that they're cutting rates to 2.5%. just to get to neutral, because they should be at their 2% inflation target, or they're not going to be cutting rates. So 2.5% gets you to their long-term neutral rate. So that's about 300 basis points in rate cuts just to get there. I can get there simply on the improvement in inflation, and we're seeing disinflation everywhere. If there's a hard landing, I think they get there much more quickly. I think you see a lot of 50s and maybe some 75s.
Wow. Interesting. We'll continue this conversation. Bob Michael, Kathy Jones sticking with us. Equities just about positive by 0.2% on the S&P with some movers. Let's say good morning to Katie Greifeld.
Hey, John, let's kick off with Tesla here. Falling slightly. That's after recalling more than 2 million vehicles after a U.S. regulator determined that its driver assistance system didn't do enough to prevent misuse. You can see shares down about 1%. Moving on, you have Vertex Pharmaceuticals up about 5% pre-market. That's after announcing positive mid-stage study results of a non-opioid treatment to treat chronic nerve pain from diabetes. It's a different story for Pfizer, as you can see there, falling after delivering a disappointing sales and profit forecast for 2024, with projected revenue sales from its COVID products missing by a wide margin, John.
Brutal. More on that around the opening bell. Katie, thank you. Coming up on the program, the White House making the case for a soft landing.
We call a sweet spot that's needed for stable growth and lower inflation, not encouraging the Fed to raise interest rates.
The latest from Fed Chair Janet Yellen and Vice Chair Joe Biden. Up next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
We learned that the economy added 199,000 jobs again this month. Solid, steady job growth. Like that, we call a sweet spot that's needed for stable growth and lower inflation, not encouraging the Fed to raise interest rates. All told, we've created 14 million jobs since we took office, more than any president has created in all 4 years of a term.
President Biden saying the strength of the labor market should deter more Fed hikes, a rare remark on central bank policy as voters continue to disapprove of his handling of the economy. And Secretary Yellen saying the path to 2% inflation shouldn't be difficult.
It's certainly meaningfully coming down, and I see no reason on the path that we're currently on why inflation shouldn't gradually decline to levels that are consistent with the Fed's mandate and targets.
Bloomberg's Anne-Marie joined us now from Washington, D.C. AMH, how about that?
Yeah, they're very optimistic, whether it's the White House or the Treasury building. A rare comment, Jonathan, as you mentioned, from President Biden, who really likes to steer clear of Fed's independence. At the same time, we're hearing from the Treasury Secretary, not just on inflation, but also questioning those that were talking about a recession. She didn't think a lot of that was really based on what is going on in the economy. At the moment, though, this administration, although they continue to tout a really incredible unemployment rate, below 4% for some 22 months. The fact of the matter is, when you look at poll after poll, Americans are increasingly worried about inflation. Even our own poll at Bloomberg, looking at swing states, when you look at these swing state voters, they see there's a deficit of a trust when it comes to the economy on this administration. But potentially, Jonathan, President Biden has seen this story before. 1992 elections, George Bush, he lost his re-election. He came out and he blamed it on then Fed Chair Alan Greenspan. And he said, well, if he would have cut sooner, would have been better economic conditions. He said, I appointed him and he disappointed me.
MH, thank you. The latest down in Washington. Bob Michael, Kathy Jones back with us. Kathy, the distance from 4 to 3, from 3 to 2, the difficulty of that last mile. Secretary Yellen saying this, the last mile isn't especially difficult. Is that good economics or just good politics?
I happen to agree with her. I've never been in the camp that says the last mile has to be the most difficult. Now, this is a very different cycle than we've seen in the past. It's probably more similar to the post-World War II cycle than it is to a demand-driven type cycle because we had such supply issues. So I tend to think that we have momentum on the downside in inflation. It doesn't have to be that difficult from here. Could there be some bumps in the road? Sure. But I don't think that given the restrictiveness of policy right now, the way the trends are going, I think it's very likely it can continue.
Bob, how difficult is that last mile?
Well, I'm with the ladies on this one, with Janet and Kathy. Inflation's going down like power windows. And you could look at the PPI, you can look at 3-month annualized rates, you can look at oil. Oil was up today, it almost got back to $69 a barrel. This is disinflation, and it's disinflation at a time when real rates are really, really high still. And that's still applying a lot of pressure to the system.
So, Bob, Secretary Yellen also pushed back against recession calls as well. Let's put it all together. If the last mile's not that difficult, how much economic pain would you expect to see then to get down from 4 to 3 down to 2?
Yeah, I think that's a really good question because a year ago, I thought today we would be in recession with unemployment above 4% and inflation below 2%. And clearly we're not. And looking back over it, I think the policy responses have become so targeted now. The Fed delivered a targeted 200 basis point rate cut back in March for the banking system. So I think it's possible to get through this with a mild recession. I don't think the laws of long and variable lags have been repealed. So I still think there's still some downside, but it's taking a lot longer to get there thanks to all the money in the system, plus a lot of the policy responses. So it doesn't have to be that painful.
So, Bob, if you've changed your view on that, have you changed your view on credit?
Absolutely. And if we go back to September, we realized that this was going to play out more slowly, that the first thing we're going to go through is an environment that is a soft landing. We're in that now. So we've looked for opportunities to continue to add duration and to continue to go back into the bond markets and pick up credit here and there.
Kathy, are you on the same page?
I'm probably a bit more cautious on the credit side. There is a lot of refinancing that needs to be done, particularly with smaller firms going through the banking channel. So we're a lot more cautious, say, on bank loans and high yield, just because the spread isn't that wide. We're not looking for a big catastrophe, but if there is a problem, it's probably going to show up when these smaller companies need to refinance in the next 6 to 12 months at much, much higher rates than they borrowed originally, 4 or 5 years ago. So a little bit more cautious there, more neutral on high yield at these levels than aggressive. We like investment-grade corporate bonds. We like agency, mortgage-backed securities. We think there's some extra money to be made there, but we have a much more up in credit quality bias.
From New York, this is Bloomberg. Always appreciate it. Coming up next on this program, the morning calls and later, Morgan Stanley's Jim Karen joins us around the opening bell from New York. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Stocks just about positive. Here are three morning calls this morning. Your first from Citi, downgrading Church & Dwight, highlighting the stock's rich valuation. Your second call from Truist, initiating coverage on Microsoft with a buy as AI projects go into production. And finally, Oppenheimer, downgrading Hertz, pointing to ongoing challenges to EV initiatives. That stock down 1.6%. Coming up, Morgan Stanley's Jim Karen on the risks and opportunities emerging from today's Fed decision. Your opening bell up next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimates, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
25 seconds away from the opening bow this morning. Good morning. We're calling it the calm, maybe before the Fed storm a little bit later this afternoon. Futures just about positive by almost 0.1% on the S&P. The move we've seen since the last Fed meeting on November 1st has been absolutely ridiculous. We've seen almost 10% of gains in that very small window on the S&P, and more than that on the Nasdaq. There's your opening bell. Switch up the board and get to the bond market. In the bond market, we've seen a move of about 70 basis points lower on a 10-year since then. We're down to 416.80 on a 10-year this morning. In the FX market, tug of war between the Fed today and the ECB tomorrow. We go nowhere. 108, 107.98 on that currency pair. Crude just about positive, still in the 60s, 68.79 on WTI. That one has been a surprise. About 25 seconds into the session, totally unchanged on the S&P 500. On the Nasdaq, just about positive. One stock to watch at the open is Pfizer, delivering a disappointing forecast. Ed Ludlow has the latest this morning. Morning, Ed.
Yeah, good morning, Jonathan. The stock down 7.5%. That puts it on track for its biggest drop since January 2009, believe it or not. If it's to close at that level. It's all about the 2024 financial forecast. Sales of $58.5 to $61.5 billion. The problem being two stories. The first, its acquisition of cancer drug maker Seagen, which is expected to close Thursday, is going to have a negative impact on revenue of about $3.1 billion. And the street's worried because they're saying, well, hold on, you're supposed to buy Seagen to diversify your offering and move away from the other story, which is demand for products relating to COVID-19, pandemic era vaccinations and treatments. Within that sales forecast for fiscal 24, they're expecting about $6 billion less sales than Wall Street was hoping to hear about in the next fiscal year. So two stories happening. The growth isn't necessarily coming from the Seagen acquisition that the market was expecting, and at the same time, that demand for COVID-19 treatments and vaccinations clearly tapering off, and the stock now down 8.4% as we speak.
Thanks for the update, mate. The stock is lower. Hit hard this morning. I have to say, though, away from the stock, isn't it a good thing that the COVID boom is over? I would say it's a good thing. Not for the stock, I understand that, but for us, for human life. About 2 minutes into the session, less of that. We are just about positive on the S&P 500. On the Nasdaq, we're positive by 1/3%. Let's turn to the automakers. Tesla recalling more than 2 million vehicles. Craig Trudell joins us for more. Craig, just how bad is this? The stock is lower by only 0.8%.
Yeah, so there's some puts and takes here, of course. With Tesla, the fanboys will say, this ain't a recall, this is just a software update. It's true that is, for now, what is happening here. This has to do with whether or not Autopilot, the driver assistance system that Tesla has been marketing for years, does enough to make sure that when you're using it, you're paying attention. You're keeping your hands on the wheel and your eyes on the road. Tesla has had hundreds of crashes with customers using this system, and some of those have been fatal. And so, you know, this is a recall that actually is a couple of years in the making since the auto safety regulator, NHTSA, opened a defect investigation into Autopilot. And that investigation will not end as a result of this recall that Tesla is initiating now. They're going to continue to monitor whether or not the remedies that Tesla has announced are sufficient and whether, you know, this really addresses the problems that have been raised.
Craig, you remember about a decade ago the Takata airbag incident and the recalls are something like 40 million compared to the 2 million right now. Do you think just we are, in general, more critical when it's new technology, when it's EVs, than when it's the old stuff?
I think that's one of the really important things about this technology is that, of course, there's real potential here for it to reduce crashes and actually make roads safer. That's a good thing, and that's why the regulators have taken a relatively light touch approach to this technology. But it's really important that if the technology doesn't go so far as to make your car autonomous, if it does not make your car self-driving, it's really dangerous to oversell the capabilities and, you know, lead to drivers thinking that they can tune out. And that's really what is sort of the crux of the matter here. And that's something that Elon Musk has taken a lot of heat for years, branding some of his capabilities as full self-driving when they're not. And, you know, even using terms like autopilot, I think, you know, that, of course, is maybe a little bit of a closer call as to whether or not, you know, that goes too far. But certainly it's been a problem for the company for years. that they've had this perception of overselling their technology, and if Musk himself is to be believed, this is the technology that makes Tesla special, right? This is the reason it's such a valuable company. If this, shakes the confidence in the direction of this technology, that's the bigger question for Tesla.
Interesting. Craig, thank you. Craig Trudeau there with the update. Not shaking the confidence of investors. We're down only 0.1% on Tesla right now. More on that story a little bit later. The broader market's still positive by 0.14% on the S&P. Let's turn to the airlines. Southwest raising its outlook for jet fuel prices. Katie Greifeld has more. Hey, Katie.
And you can see the stock dropping from the bell after Southwest said that revenue for each seat flown a mile will decline by no more than 10% in the quarter versus a year earlier. That's according to a filing today that we're getting these updated numbers. That is slightly better than the earlier forecast for a year-over-year drop of about 11%. So again, slightly better when it comes to the revenue outlook, but short of the guidance boosts that we got last week from the likes of JetBlue and Delta, both signaling strong year-end demand. And Southwest would tell you that they also see strong year-end demand, that they had a record Thanksgiving, but domestic-focused carriers in particular, they've been really plagued by an oversupply of plane seats that's forced some of them to cut fares. And as you mentioned, you also have those fuel costs to contend with. Southwest actually raised its outlook for jet fuel prices by about 10%, or rather 10 cents per gallon. You add it all together, shares currently off about 4%, John.
29 per share in the early part of trading. Katie, thank you, as always. Let's turn to the food space. Cal-Maine closing one of its facilities after a positive test for avian flu. Alex Semenova has the story. Hey, Alex.
Hey, John, good morning. You might want to skip the breakfast eggs after hearing this one. Cal-Maine Foods is closing one of its Kansas facilities after some of its flock tested positive for the avian flu. Cal-Maine is the largest producer of eggs in the U.S. It said that the highly pathogenic virus affected about 700,000 laying hens. That's about 1.6% of its total flock. Shares were down as much as 7% in post-market trading yesterday. Not a big move lower this morning, though. Cal-Maine said that it's following U.S. Department of Agriculture protocols to deal with the findings. It's also working to secure production at other facilities in order to minimize disruption to customers. The company said that it would update investors on the detection in January when it reports earnings results. That's, of course, unless any material information comes up for any interim updates. Cal-Maine said there have been no positive tests for avian flu at any other facilities so far. John?
Alex, thank you. The stock's doing okay. It's up about 6%. We are about 4 hours and 23 minutes away from a Fed decision. Going into that, we're just about positive on the S&P 500. The Nasdaq higher here by 0.5. Morgan Stanley's Jim Karen looking at how the Fed's decision will affect next year, writing this. The naughty policy rate is the rate that is too high or too low and creates either a recession or inflation. The nice policy rate is the one that perfectly balances the two, and we achieve trend growth. Jim, I'm pleased to say, joins us right now. Jim, I want to get into it. I'm reading your note. Can falling rates be consistent with higher for longer? Just explain that for us all.
Thank you for having me on your show. Yes, the Fed is making its list and checking it twice, right, to see which policy rate is naughty or nice is really the theme. So the way that we look at this is we have to think about policy rates in real terms. That's the nominal policy rate minus inflation. So as inflation comes down, the nominal policy rate should also come down to match it to keep the same level of monetary policy tightness in the system. That's just the way it works. And that's essentially what we call the neutral real policy rate, which is that optimal policy rate that balances growth and inflation and keeps us at potential growth. So it could be that the Fed has to mechanically lower policy rates as inflation rates are coming down, and the same level of tightness will be kept in the markets. So saying that rates are higher for longer should be viewed in real terms, nominal minus inflation, in real policy rate terms. So the nominal policy rate can come down, and that effectively you could still keep rates higher for longer because the real policy rate may stay unchanged.
Jim, a few months ago, New York Fed President John Williams engaged in that conversation. It's fairly intuitive once you have it. Now, Jim, do you think that's a conversation Chairman Powell wants to have in the news conference today?
Well, one of the things that the Fed doesn't really talk about is what their view of the neutral real policy rate, what we call R star, actually is. So this has to be an estimated number. We think of it as like this magical number that's out there that perfectly balances everything. They're not going to come out and say that the neutral policy rate is X. They will be asked that question. Now, what economists estimate is that neutral policy rate is actually somewhere between 1.5% and 2%. So that would suggest that if that's the case, and if inflation is likely to be around 3% forecasted by the Fed next year, then that would mean that the Fed could cut interest rates next year by 100 basis points, which is roughly what's priced in the markets right now. The markets have about 125 basis points of rate cuts priced in. But think of the first 100 basis points of rate cuts as actually not easing policy, it's just keeping policy neutral. They'd have to cut rates by more than 100 basis points. But this has an impact on asset prices because if interest rates come down, asset prices tend to go up. That includes equities.
So, Jim, you don't think that call for 100 basis points of cuts requires economic weakness next year?
No, I think it could actually be somewhat mechanical. Now the question is if the Fed, and this is the question that's going to be put to the Fed today, and this is what we have to listen for, is does the Fed believe that this decline in inflation that's happening right now, is that likely to be permanent, meaning will it remain anchored at low levels? Or is there a risk that in, say, the second half of next year, that inflation then starts to rise back again and becomes unanchored? And this is what the Fed has to debate, right? So if in all else being equal in a perfect world, if inflation's anchored around 3%, the Fed would likely have to cut interest rates next year by 100 basis points. But if they believe that there's still some upward pressure towards inflation, and there's reasons to believe that, we haven't won the inflation battle yet, that they may be slow to actually cut interest rates, and that's what we're going to be debating next year.
Well, let's have the debate on equities right now, Jim. How much of the gains for next year have we already pulled forward into November and early December?
Yeah, I'd say that. I mean, that's really the issue right now, because effectively, the calls for the year ahead forecast for next year were inflation's coming down, the Fed's likely to stop hiking, probably going to cut interest rates. All of that price performance right now is being pulled forward in 2023. That's the reason we've had this, as you said on your show earlier, a 10% rally since November in equity markets, in credit spreads, high yield bond spreads, investment grade bond spreads. All of that is compressed. Basically, that's all pulling forward that good news of lower inflation and potentially lower policy rates. Now, what that means is that the hard work begins on January 1st, 2024, because in order to get higher equity prices, you need to see another positive catalyst, which would mean upside surprise to growth. And I would argue that we've probably seen, probably about 75–80% of the pull forward of what we had expected for next year's returns. That might only leave returns left over in the equity markets somewhere around like 5%. And that's okay. But look, I wish the year began on November 1st, right? Because we'd be up 10%, right? On a year-to-date basis. But unfortunately, it begins on January 1st.
Well, Jim, in many ways, the year did begin. 2024 did start in early November because we started to price in this happy story. Year to date, I've got the Nasdaq Composite up by something like 40%, up 21 on the S&P 500, up 10 percentage points since early November, since the Fed last met. Jim, I remember a conversation you and I had almost 12 months ago. Maybe it was the start of this year, the start of 2023, and everyone was worried about downside risk. And you said upside risk is a risk as well that you need to appreciate and be positioned for. Jim, how do you feel about that now going into next year?
I still feel the same way. I still think that people are focused on the downside in the market. Certainly equity positioning would suggest that. I think there are still high levels of cash. People are putting money into bonds, and there's nothing wrong with putting money into bonds. Starting yields are higher, and I think inflation's in check. But there is some potential for upside, and it could even come from the stimulus side of in terms of fiscal policy as we get into 2024. And as the market starts to price that, and as the market starts to think about that, you could start to see a broadening of the markets. And I don't like to make year-ahead forecasts, but if I were to make one, I would say that the broader market outperforms the Magnificent Seven, next year. So I would think that a balanced portfolio is actually going to do pretty well, because if you look at the multiples and the valuations of the other 493 stocks, it's much closer to averages. It's around 16 and a half PE, as opposed to when you include the Magnificent Seven, the 1 year head forward PE somewhere around like 19. So it could be a little bit frothy. So I'd say that the broader market's a balanced portfolio, having some value, some growth, well diversified, even some fixed income, because I think fixed income returns can compete with equities as well, could actually give you, reasonable returns next year.
Jim, thanks for making a call and not making a call simultaneously. We appreciate it. Jim Kerrin of Morgan Stanley. Jim, enjoy Christmas. Great to catch up, buddy. Always is. Equities right now on the S&P positive by 0.1%, about 15 minutes into the session. Coming up next, the EV growing pains continue.
We are seeing these this uptick in sales for electric vehicles that we've seen in the past. Of course, it is challenging to reshape an entire economy, to build a new clean energy economy.
Yesterday it was Ford, today it's Tesla, recalling 2 million vehicles to fix autopilot safety flaws. That conversation up next.
Emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
we had some pretty tough talk.
Bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report tonight at 9:30 Eastern. Bloomberg, context changes everything.
The annual prize money pool in LPGA tournaments has grown 50% since 2019. In 2023, it topped $100 million. But the prize fund still lags far behind what men compete for on the PGA Tour. The inequality hits hardest at the lower end of the money list.
Clearly, we want the top players to continue to make a great living playing. These are the very best in the world. But we also then dig in and say, okay, what's the 50th best player in the world making, and what did she make last year? I've asked Kathy to run numbers many times to say, okay, tell me where we are exactly during the middle of the season, at the end of the season.
That 100th player, our goal would be to obviously have that player make considerable amount of prize winnings, and we're going to work really hard to do that. Having said that, we do need to continue to focus on ways to provide opportunities so that 100th best player can cover those costs that it takes for them to be out here on the golf course. That's hiring a caddy, that's travel, that's strength coaches. We're helping to provide stipends for health insurance or create a tour-wide health insurance program. Ability to create more discounts for travel, for hotel and car and all those things that really cost them a lot.
To meet these objectives, LPGA leadership collaborates creatively with sponsors.
We've worked with some of our corporate partners to say, help us solve a problem. Help us create a fund that will allow our players to get to the first tee ready to reach peak performance.
We are seeing these historic investments, as a result of the Inflation Reduction Act. We are seeing these this uptick in sales for electric vehicles that we've seen in the past. Of course, you know, it is challenging to reshape an entire economy, to build a new clean energy economy, but knowing that the president has done what he could do, working with Congress to be able to make sure that businesses have the support they need to be able to make these investments, that's where our energy has been focused.
The White House reiterating Biden's big plans for the EV space during a troubling week for automakers. Tesla recalling over 2 million vehicles for autopilot safety flaws. Regulators determining the system is ripe for misuse, saying this: automated technology holds great promise for improving safety, but only when it is deployed responsibly. This on the heels of Ford slashing 2024 production goals for its signature EV due to slowing demand. Your team coverage begins right now. Ed Ludlow in San Francisco, David Welch in Detroit. Ed, just how bad is this for Tesla?
It's recall in name only, in the sense that the fix is an over-the-air software update. 2 million vehicles in the United States is basically every operational Tesla in this country across all year and model types. But it's the result of a basically 2-year double look by NHTSA at autopilot. And it is autopilot that we're talking about in this instance, not full self-driving beta. Literally the ability to maintain a speed and keep you within the lane. And what NHTSA found is that there just weren't sufficient on-screen warnings and reminders to the driver to keep their hands on the wheel and their eyes on the road. It's worth noting as well that Tesla did not agree with NHTSA in its findings, but acted voluntarily to do that soft recall, recall in name only, but continued scrutiny of the future of driving and you know, another agency looking at Tesla and its technology.
A reality check on several fronts for the whole industry, David, in the last 24, 48 hours. I want to sit on Ford with you, David, just for a moment. Ford has been somewhat transparent about what's been happening with demand. We caught up with the CFO only a few weeks ago about that. Do you see the cut to production goals as just an inevitable bump in the road towards EV adoption, or is it something bigger here? Are we going too quickly?
In a way, we are going too quickly. I guess I'd say it's sort of both of the things you just described. Every technology geek, every person who really wanted an EV, and rich people who like luxury cars, most EVs are luxury cars still right now, they got theirs. And now we're trying to penetrate the mass market. And to do that, you need a better charging infrastructure, but you also need cheaper EVs. And the F-150 Lightning is very expensive. And most of them transact for well over $70,000. So, yeah, there is slowing demand. It is still growth in terms of the EV market. And it's the only place in the auto industry where you're seeing any kind of growth. So everybody needs to be there. But they are getting more cautious with their investments. Ford announced that they're cutting their EV investment by $12 billion, and I think this is a piece of that. General Motors hasn't said that, but when they're returning $10 billion to shareholders with a big buyback and raising the dividend, that tells you that they may know in the future they're going to have to slow down their investment in EVs, therefore they will have the money to afford these returns to shareholders.
David, I've been asking if this is a change in strategy or just a change in execution, and I'd say both GM and Ford would say it's the latter and not the former, but at some point, David, you start to think about maybe leaning towards hybrids and away from EVs.
I think they're going to have to, given how aggressive the federal fuel economy and clean air standards are, and the fact that hybrids are selling very well right now. A lot of consumers just aren't totally sold on EVs. They're worried about the charging infrastructure. That's being built out. There's the consortium of automakers that spend a lot of money to build out the infrastructure. So is Tesla. Everyone can use Tesla's charging infrastructure going forward. But no one's really marketing that. So consumers are still worried about it. Perception's reality. If you can't convince consumers that they're able to charge their cars and they won't be stranded and that they can afford EVs, they're not going to buy them at the pace that they have been. And I think everyone's going to have to either start marketing hard or throttle back investment, probably a bit of both.
Too true. David Welch, thank you, sir. Ed Ludlow on the West Coast and Detroit, respectively. Thank you, gents. In your equity market right now, the S&P just about positive by 0.06%, the Nasdaq up by 0.2. I'll just go through the bond market for you quickly. We're set up like this. The 2-year coming in 4 basis points on a 2-year yield, about 4.69 at the moment. On a 10-year, we're down about 3 basis points to about 4.17. This all ahead of a Fed decision coming up a little bit later. Coming up next on this program, we'll get to the trading diary, a sneak peek at the calendar for today and through the rest of this week. That's next. This is Bloomberg.
What did you learn in the last 40 years about leadership in politics?
Well, I've learned a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way. Know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Around about 25 minutes into the session, almost 26. Your equity market on a 4-day winning streak on the S&P, just about positive today by 0.1%. That's the price action. Here's the trading diary. You know what's coming up a little bit later? Fed rate decision, 2 p.m. Eastern time, followed by Chairman Powell news conference, 2:30 Thursday. An ECB rate decision along with the Bank of England, and we'll get US retail sales as well. The show a little bit later, set up as follows. Here's the lineup for the Fed special. Bloomberg surveillance, the Fed decides, with Priya Misra of JP Morgan, Subhadra Shapra of SocGen, Jeff Rosenberg of BlackRock, and former New York Fed President Bill Dudley. Stacked program a little bit later. I'll catch you for all of that this afternoon. From New York City, thank you for choosing Bloomberg TV. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries? Soft landing, hard landing, no landing? I don't know. True. What the heck does that mean? I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Brokers studio in New York City to our worldwide audience. It is Fed Day. That means we need to check in with some experts here on what we might hear from our Federal Reserve. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. She's going to join us in studio, so that's a treat. Ted Smith, co-founder of Union Square Advisors, former banker at Credit Suisse with me. He's going to talk to us about the M&A biz in 2024. Kara Murphy, CIO at Kestra Asset Management, is going to join us with her market call. So it was like checking in with her. But let's kick everything off here with Mr. John Tucker on the Bloomberg Business World.
All right, let's start off with some breaking news crossing the Bloomberg. It's a red headline, so I guess it's important. The SEC is going to force hedge funds and brokers to clear more Treasury trades. Bailey will be along in a moment to explain all of it. The Federal Reserve, of course, wrapping up its final policy meeting of the year, and ahead of that, the major averages right now mixed a little change. 8 of the 11 major industry groups in the S&P 500 lower. Pfizer, of course, the worst performing individual stock in the index, down 8%. Meantime, John Stolfus at Oppenheimer says Fed rate cuts are coming, just not as soon as everybody thinks.
The Fed has shown remarkable sensitivity as it practices its mandate to keep untoward levels of inflation in check. And so all in all, we think this looks good, as with cuts likely to happen in the second half of the year.
Right now, the S&P 500, 2 points higher, 46.45. I should note it's 3% away from its all-time high. Dow Jones Industrial Average right now 12 points lower, and the NASDAQ 100 is up 29 points. That's a rise of 0.2%. 2-year yield lower, 3 basis points lower at 4.69. And then Citigroup will wrap up with this, offering to pay some staffers a portion of their bonuses early. Sounds good if they agree to quit. So executives continue with their restructuring. Here's your bonus. Now leave. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Bailey and Paul.
All right, John Tucker, thank you so much. We have Bailey Lipschultz in the revolving chair, musical chairs of co-hosts. You land in it today.
I'm here today. I'll be here Friday. I don't know if you'll be here Friday.
No way, please. I'm a player. Bailey Lipschultz. He's my co-host here, Paul Sweeney. We're live in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube, so you can head over to youtube.com and search for Bloomberg Radio. And that's where you'll find us. A little bit of red and green on the screen. No real movement on the index level. Let's look under the hood and see what's happening on the equity markets. Carmen Reineke joins us. She covers all the markets for Bloomberg News. Carmen, what are you looking at?
Yeah, the biggest thing that I'm looking at this morning is Pfizer, ticker PFE. Shares are down about 9% right now. This is the lowest since July 2013, so over a decade drop here. Basically what happened is Pfizer forecast revenue for next year that's short of analysts' expectations. It's saying that sales will come in between $58.5 billion and $61.5 billion. Wall Street saw nearly $63 billion. And the reason this is surprising is they just spent so much money to purchase Seagen, which has a is a drug maker producing some of the best treatments in oncology. So I think analysts are expecting just a little bit more revenue boost here for Pfizer from that acquisition.
All right, here's the tail of the tape for Pfizer. And again, I give them huge kudos because they delivered a vaccine for us when we desperately needed it. And for that, forever I'll be thankful, and I think we all should be. But you look at the income statement here. In 2019, they had 41 billion of revenue. By 2022, that was $100 billion of revenue. Thank you, COVID. Now the forecast, and then 2023, that dropped down to 58 billion.
Right.
So, I mean, COVID giveth and taketh away in terms of that revenue associated with it.
Yeah, and the shares have really reflected that. I mean, Pfizer is down more than 40% this year. That's a huge drop, and it is very far from its, 2021, 2022 highs.
Yeah, talk about the haves and have-nots. Lilly in the obesity space up 61%. To your point, Paul.
Great point.
Pfizer nowhere near where it was trading before. Carmen, got to ask about the flights. We've seen airlines outperforming recently. A lot of companies talking up expectations for the holiday season. Not so much Southwest.
Yeah, no such love for Southwest Air, ticker LUV. Right now, it's down about 6.5%. It did raise its outlook for fourth quarter revenue. It says that it will have a stronger holiday season, higher travel demand, higher ticket prices. However, the outlook was raised saying just that it will have less than a decline. So basically revenue for each seat per mile, am I saying that correctly?
Yep.
Yes, is going to decline no more than 10%. And that was a previous expectation was 11%. So, this is just not looking so good for Southwest. And the other thing is its competitors JetBlue and Delta have given much better outlook guidances over the last week. So, just no love from investors for Southwest. It's still just falling short of.
Yeah, we had Bob Jordan in studio in the last hour, and he said something interesting. He said basically, leisure travel is back. Business travel, he said, they've actually, I kind of got the sense that it's not going to ever, they don't envision it coming back to pre-pandemic levels. And he specifically said they've adjusted their Tuesday and Wednesday flights to reflect that.
Wow.
Take some capacity out because they're just not on some of their existing business routes. So they're not seeing that business travel come back. So they're just adjusting their capacity, adjusting their whole flight network to reflect that. But the consumer remains extraordinarily strong on the leisure travel.
Well, I mean, it makes sense. I mean, why would you pay for a flight when you can just do a Zoom if you don't need to be there in the room?
Well, don't get me going because I'm all about hitting the planes and getting out and seeing people. That made my career. Do it over the phone, kids. Tesla, what's happening there with Elon?
Yeah, Tesla shares are down almost 2% right now. The electric vehicle maker filed a recall of more than 2 million vehicles. The top U.S. auto safety regulator said that its driver assistance autopilot system doesn't do enough to prevent misuse. There have been some issues with this that have resulted in crashes that have included fatalities. Tesla is recalling these cars, and it's also sending out software updates over the air for some of those vehicles.
Tesla's always been valued by the market as a technology company. But now it feels like it's more of an auto company when it's getting recalls from the federal government. That makes it seem like you're in the car business.
Kind of walking the weird fine line. But as Matt Miller would probably point out, recalls happen all the time. Right. Granted, not for safe autopilot driving, which is kind of what Tesla has been pushing alongside solar panels and everything else going on.
Apple on track for an all-time high?
Yeah. This is one that we are watching today. It was up at least 1% on track for its all-time high close. I think this is one we're going to be watching all day. It's really going to come down to what the Fed does this afternoon if this rally continues to go. Obviously, tech and the Magnificent Seven have been a huge story this year, and we're just kind of waiting to see if this what investors are thinking is going to happen, which is that there will be rate cuts next year, kind of keeps this rally going.
All right, I'm just looking at Apple here, $3.05 trillion with a T market cap. Stock's up 0.8%, 51% year to date, just a beast. Good stuff for our friends in Cupertino. Dan Ives, Wedbush Securities, been pounding the table on this thing like crazy. Carmen Reinke, thank you so much. We appreciate that. Carmen Reinke does all the market stuff for Bloomberg News. We got her here in our Bloomberg Interactive Broker Studio. All right, it's Fed Day. Very, very simple. we say we got to get Danielle DiMartino Booth in here because we need to figure out what's going on with this Federal Reserve. Danielle's the CEO and Chief Strategist for QI Research. She joins us live here in the Bloomberg Interactive Broker Studio, making the trip up from Dallas, Texas, where she was a former advisor at the Federal Reserve Bank of Dallas. So for better or worse, she's one of them. You are one of them.
Oh my gosh, I'm a former one of them.
Exactly.
Former one of them.
So Danielle, what do you think the Fed Chairman Jay Powell? What's a win for him today? Do you think?
I think right now Powell. I think we need to see the Powell who we saw a few years ago at Jackson Hole, succinct, to the point. Financial conditions have eased to such a great extent, even since the Fed went into blackout. So I really do think that he needs to be resolute and emphasize that they're still data dependent and communicate that the market's gotten way ahead of itself.
Okay, so let's go there. You think the market's gotten way ahead of itself. 10-year Treasury was 5%, as Tom Keene would say, just a cup of coffee ago. Now we're at 4.16%.
Yes, we are.
What happened?
Well, look, this is the Deutsche Bank. Deutsche Bank's Jim Reed does a great job of tracking Fed pivot rallies.
Okay.
We're in number 7 right now. 7 since the Fed started to raise rates in June of 2022. So the markets are constantly pushing Powell to acquiesce, to break, but yet nothing's broken yet. When he broke in late 2018, it was because bond issuance froze solid for 41 days. He had to break because the market was saying systemic risk. There's no systemic risk with stocks near all-time highs at all. And that's why he's going to push back. And that's why he's going to say, until we get, he's going to repeat. His very first interview after he got reconfirmed by the Senate, he gave to NPR, he used 2% target 14 times in a rather short interview. And he hasn't changed his tune since then. And that's what I think frustrates so many investors, is that they want for him to be somebody who he's refused to be since he was reconfirmed.
And Danielle, we look at some of the commentary we've been hearing from Powell. What can he actually say to maybe push back? Because we look at individual words being changed and words being removed from what he's saying, and that's driving the markets right now pricing north of 4 cuts next year.
Sure.
What does he do?
Well, I think he points to his precious supercore, which Haver Analytics has actually added to their platform. He says my supercore is still too hot, so I'm not convinced that CPI X energy X shelter, I can't even remember the definition right now, is slowing to a sufficient degree for me to be convinced that we're going to hit 2%. If he starts to bring up some of the things that he's, by the way, conjured out of thin air. Then I think that markets will start to get the point.
How about the labor market here? Boy, that was a lot stronger than a lot of people thought.
And he's gonna reference
yes,
that all day long and on Sundays.
So I know you peeled the onion back 1,000 layers. When you looked at the labor data, what did you really see?
Well, what I saw was I tried to look at the labor market in 2023. And what I saw was 1.32 million jobs had been imputed by the birth-death model. 52% of job creation in 2023 is an imputation by statisticians.
Imputation?
It's based on births going wild when we've got bankruptcies running at the fastest pace since 2010. So square that circle. Yeah. And by the way, the BLS, since they introduced this in 2001, has been incorrect at every inflection point in the economy, and they've packed too many births in there that they then had to revise out in prior years, and revisions are up to negative 372,000. In terms of what's been reported, government job creation's gone through the roof.
All right,
the private sector is not.
I want to just quote from